is talking about your levy of customs. The charging section of customs happens to be a section 12, but along with this charging section we'll be seeing certain special sections as well. The first of those sections would be a special charging section being section 20 and section 21. Clarification to charging section being section 20 and 21. Then exception to the charging section where you'll find certain different concepts there. Levy will be there, but collection will not be there or will be at a lesser value. Pilferage loss, section 13. Abatement for damaged goods, situated goods, section 22. Remission, when you talk about your lost or destroyed goods, 23.1. Relinquishment, section 23.2. Denaturing, section 24. And finally, we will be touching even your refund in section 26A. But that would be finally when we are done with all these points. So basically focusing on your levy part, section 12, read along with your section 20 and 21. Now what is section 12 telling? Only 3 P's. Unlike your GST, customs requires only 3 P's. Product, process, place. Product, process, place. Product should be goods. Product should be goods. Processes, your import of goods or your export of goods. Process is either import or export. Place happens to be your India. Place happens to be your India. Even for customs though, India is defined to include TWA. As per Supreme Court judgment, you have to read it as EZ up to 200 nautical miles. Up to 200 nautical miles. So, product, process and place. Product, process and place. Goods imported in India or goods exported from India. Goods exported from India. The moment you satisfy all these 3, you will be covered by your charging section, section 12, and you have to pay a duty which is there under Customs Tariff Act. What is the normal duty that you end up paying? If at all it is import duty, we have been discussing for long time, it is BCD plus SWS plus IGST. Export duty first of all is very rare, but there. Very rare, but there. The concept is destination based consumption tax. So normally there will not be any export duty. But whenever it is that, it is only and only BCD. It is only and only BCD. Import duty, whenever it is there, it is BCD, SWS, IGST. Special import duties may also be there, but these are all normal import duties. Whenever I tell IGST, if it is having compensation cess, it will be IGST plus compensation cess. But for export, understand that normally export duty will never be there. If at all it is there, in rarest of the rare case, it will be only BCD. It will be only BCD. Now, talking about calculation of your customs duty, you require assessable value and you require rate of tax. Unlike GST, in customs valuation, we will be seeing that assessable value can either be your transaction value, section 14.1, that was section 15, here it is section 14.1, or it can be for notified goods by central government. It can be tariff value. Goods notified will be by central government, but tariff value will be given by CBIC. So here, either normally it is transaction value, but for notified goods by central government, it will be tariff value which is given by CBIC. So it is either transaction value or tariff value. Rate of duty. As I said that if it is import, there will be import duty, for which you have to refer to first schedule of Customs Tariff Act 1975. If it is export, you may have export duty, very rare, but you may have second schedule of Customs Tariff Act. Customs Tariff Act second schedule will have very few goods, because export duties are on very few goods. Rather, government, when they will try to have export duty on goods, either the item is very scarce. Actually, main reason is the item is very scarce in India. Scarce in India, or for some reasons they want to have that, create that demand. For some reasons, maybe macroeconomics level, they might plan something and they might do something. Very rare scenario, it will be that, right? Export duty. Whenever you have import duty will have two rates, which is very special only in customs. One item will have corresponding two rates. One is called as standard rate, and one is called as preferential rate. One is called as standard rate, one is called as, so one item, say item X will have 10% as well as say 7.5%. Now you may be confused which rate to select. If you are importing from your most favored nation, what is most favored nation? If you are importing from your most favored nation, which means member nations of World Trade Organization plus countries with which you have bilateral agreement, then you will go with lesser rate, preferential rate. But if your import is not from most favored nation, you will go with higher rate. In rough understanding, friendly nations, enemy nations. Roughly, don't use these terms. Friendly nations, enemy nations. The technical word is most favored nation, preferential rate, other countries. If you are importing from other countries, standard rate, which is the higher rate, So this is the main charging section that you have, section 12. Now exception to charging section. One exception talks about your reimportation. See, exception, both the exceptions focuses only on one thing, imports. Exception is focusing only on revenue, imports. Section 20 talks about reimportation. Reimportation. What is happening? The goods are re-imported after exportation. You exported it, now you are bringing it back. You exported it, now you are bringing it back. So that is re-importation of goods in India. That is re-importation of goods in India. There was an export, again there is an import. They are trying to clarify that though it is re-importation, we are going to charge customs duty. It will be treated as new imports, fresh imports. We will not give them any relaxation. But having said so, there are exemptions. There are exemptions for reimportation which are quite often asked. There are relaxations. There are exemptions for reimportation. But prima facie levy tells that if it is reimportation, default thumb rule is treated as new imports. Treated as new imports. We will tax it. The next category is your section 21, which again only talks about import, but it talks about special items, be it derelict, jetsam, flotsam and wreck. Derelict, jetsam, flotsam and wreck. Now what is derelict, jetsam, flotsam and wreck? Derelict means a vessel or the cargo inside the vessel which is abandoned in the sea without any hope of recovery. Basically, it is the vessel along with the cargo. It is not cargo and vessel, it is vessel and the cargo. Vessel and the goods inside the vessel which is abandoned without any hope of recovery. Now, what is wreck? A vessel which is damaged and now it is drifting along with the cargo. A Titanic kind of situation. The vessel which has been damaged, now it is drifting inside this sea and coming to the shore along with the cargo. One is abandoned, one is damaged or destroyed. And in this case, they talk about both vessel and the goods inside the vessel, that is cargo. But what is jetsam and flotsam? First, you need to understand jetsam, then you will understand flotsam. Jetsam means the cargo, only goods which are jettisoned or thrown away from the vessel in order to save the vessel from sinking. Few cargo will get sunk and they are not abandoned. They are thrown. At times they will mark it. Okay, this is the area where we have thrown it. So next time when we come with other tools or equipments, we will try to take it away. So that is jetsam. You are thrown inside and they go deep inside and they are not going to float. What is flotsam? Flotsam is also those items that you have thrown from the vessel because to save the vessel from sinking. But the difference is they will be floating and they will be automatically, both are not abandoned. Whether it is Jetsam or whether it is floatsam, you are not abandoning. As of now, you are throwing it. Rather, it is easier to find your jetsam rather than find floatsam, because jettition goods, those who are going inside and sinking inside the sea, you can easily find it out. But floatsam, you will be throwing it and it will change place. Difficult to find out unless there is a tracking. Maybe nowadays you can put a tracking device in through, which is now done by all the shipping companies. All the shipping companies, whenever they are throwing any goods, they put a tracker. If it is working well and fine, then they may be able to track it. So that is jetsam and floatsam. The focus is only on cargo. Now, why this is discussed in section 21? Whether it is derelict, wreck, jetsam or floatsam, look at the language. Whether they are brought or coming automatically. Whether they are brought or coming automatically in India, they will be taxed. They will be taxed. So proper officer will deal as if they are being imported unless there is an exemption. They will be taxed. If nobody is coming and claiming the ownership, you might ask, who is going to pay the tax? If someone tells it is my goods, tax will be collected from that person. Finally, there will be a question comes. Okay, if no one is claiming the ownership will go to the Government of India, Customs Department. If no one is coming forward, in spite of the advertisements given by the Government of India telling that these goods are coming from so and so vessel that we have found out, and if at all you are the owner, bring along with the corresponding documents. If you are coming, you have to pay the duty. No one comes, the goods will go in the treasure of Customs Department. Customs Department. They don't want to leave an opportunity. They are just telling that whether it is re-importation, pay import duty. Whether it is jetsam, floatsam, derelict, direct, pay import duty. Pay import duty. These are mere clarification. Section 20 and 21, even they were not there, even then import was happening, even then payment would have been done. But they are very cautious and giving these clarification that whether it is re-importation or whether it is jetsam, floatsam, derelict, wreck, which is brought or coming, automatically we will collect import duty. We will collect import duty. Now, what is left out here is your section 20, re-importation. Re-importation has got a relaxation. Re-importation has got a relaxation. There are basically two exemption notification. Exemption notification 45/2017 and exemption notification 158/95. There are two exemption notifications. So if you are covered in these two exemption notification, either there will be partial exemption or there will be full exemption. Re-importation is happening. Re-importation is happening. Let us see these exemption notification. In this first exemption notification 45/2017, there are three situations or three scenarios. There are in totality three situations or three scenarios. Three situations or three scenarios. What is the first scenario? You are talking about a case where goods were exported under the claim of duty drawback, which is a provision of customs, or refund of IGST paid on export, which is a provision of GST, or bond or LUT without payment of IGST and then claiming the refund of unutilized ITC, which is again a benefit provision in GST, or duty exemption scheme, which is advance authorization or duty free, export promotion capital goods scheme, which is a benefit of foreign trade policy. You have exported goods taking export benefits, be it customs benefits or GST benefits or foreign trade policy benefits or combination of all. So you have taken the benefit under customs law. You have taken the benefit of exports, be it under any law. Now, what is happening? The goods are re-imported. The goods are re-imported. Now, look at the way re-importation should happen. The time limit for re-importation is 3 years plus 2 years extension. The exported goods and the imported goods should be the same. The exported goods and the imported goods should be the same. If at all the goods are sent for repairs, ownership should not have been changed. Simple language. Goods should be the same. Owner should be the same. Time limit is 3 plus 2 years. Goods should not change. Owner should not change. The person who has sent it, only that person has to receive it. At times I will be sending the goods because of repairs. When I am getting it, I should be the same person, importer. And finally, the time limit to bring back the goods. The goods went outside. If you want to take the benefit here, you have to bring it back within 3 plus 2 years. 3 plus, these conditions are not only for first situation, they are for all the three situations. Therefore, all the three situations. What is the benefit for the first situation? Let us only first focus on the first situation. What is the benefit? You are required to pay a duty which is lower of actual import duty or export benefit that you took at the time of export. You have to pay import duty. If the actual import duty is 1 lakh and export benefit you took at the time of export is 80,000, how much you will pay? 80,000. If actual import duty is 1 lakh, if export benefits that you took at the time of export is 1,20,000, how much you will pay? 1 lakh, whichever is lower. If actual import duty is 1 lakh, if you never took any export benefits, how much import duty will pay? 0. What is the answer? Actual import duty or export benefit, whichever is lower. So in the third case, I said actual import duty is 1 lakh. At the time of export, you did not take any export benefit. You did not take any export benefit. So 1 lakh or 0, whichever is lower. Understand that whichever is lower is the duty payment. Is the duty payment. So what you are going to pay is 0. So what is exempted is fully exempted. What is exempted is? Go back to the first example. Actual import duty is 1 lakh. Export benefits taken at the time of export is 80,000. How much you are going to pay? 80,000. What does it mean? 20,000 is exempted. 20,000 is? Second example, no exemption. Actual import duty is 1 lakh. Export benefit was 1,20,000. How much you will pay? Entire 1 lakh. No exemption. So you will find all the three cases. Full exemption, partial exemption, no exemption. By applying this, you may be covered under any of them. So what is the duty payment that you make? Actual import duty or export incentive at the time of export, whichever is actual import duty at the time of reimportation, export incentive at the time of exportation, whichever is lower. Whichever is, this is not exemption, this is duty payment. This is not exemption, this is, and if you compare finally, you might find what is exempted. This is duty payment. Now what is the second scenario? Second scenario is the goods are exported without any export benefits for repairs. For mere repairs. For mere repairs. This should not amount to remanufacturing or reprocessing by melting, recycling or recasting. Mere processing, not amounting to remanufacturing, reprocessing, melting, recycling or recasting. Now understand the scenario. Okay, if I were to explain this first situation in a very simple way, there was sale and there is sale return. There was sale, export, and there is sale return, re-import. In the second situation, initially there was import. A very important point that ICAI has asked repeatedly, second part. Rather, in the entire chapter, if I would tell that what is the most important area in this entire chapter, it is the second point here. So what has happened? You have purchased the goods, imported in India. Now you are sending the goods for repairs. Sending the goods for, not selling it, sending the goods for repairs, which is re-exportation or exportation. And again you will be bringing back the goods where there is re-importation. Where there is re-importation. Where there is re-importation. You imported the goods, paid import duty. You are exporting it and it is clearly mentioned that you should not take the benefit of exports. Now you are re-importing it. Should you pay import duty is the question. Already you imported the goods, already you paid import duty. You had sent it for repairs, not for manufacturing, remanufacturing, reprocessing, recasting, recycling, remelting. Only for mere repairs. Now it is coming back. If you see this entire chain, already you have paid import duty. Should you again pay import duty? Should you again pay import duty? Yes, you are required to pay import duty again, but the value for import duty. Now it is not import duty calculation. It is value for import duty. That you will multiply it with import duty rate. The value will be whatever value additions are done outside India. Supposing the machinery value was 1 crore. You imported for 1 crore. You already paid import duty on 1 crore. You send it for repairs. You bring it back. At the time of bringing it back, on what value you will pay? You will not pay import duty again on 1 crore. You will pay on the freight and insurance charges from India to outside India. The freight and insurance charges from outside India to India. The cost of repairs and the cost of materials used in repairs outside India. Whatever is happening outside India. Whatever is happening, I'll be sending it first. Freight insurance from India to USA. There'll be repairs. Fair value of repairs, including the cost of materials used in repairs. Again, it will be coming back. Freight and insurance from USA to India. That will be the value. Is this the tax amount? No, this is not the tax amount. This is value. This is value. Then use the customs duty rate and pay the duty. Customs duty rate will be that of machinery only, not of services. It will be that of machinery, but value is reduced. Why it is reduced? You are not going to pay import duty again on entire 1 crore. You imported the machinery. You have already paid the import duty on 1 crore. Now there is a problem with machinery. You are sending it for repairs. You are bringing it back after the repairs are over. After the repairs are over. So if at all you are asked to pay again import duty on 1 crore, it will not be fair. Therefore they tell that, okay, you have to pay import duty, but on what value? Freight and insurance from India to outside India to India. In outside India, what was happening? Repairs. So take the fair value of the repairs, including cost of the materials used in repairs. Even if the repair is done free of cost, you have to take the fair value. Even if the repair is done free of cost, you have to take the fair value of cost. So that is given here. Here this note is mentioned whether or not such costs are incurred, which means even if it is done free, for customs duty purposes, you have to add all these. You have to add all these and pay import duty. And the last scenario here, what is happening in the last scenario? Last scenario, you have sent the goods for exhibition. You have sent the goods for exhibition, export. You are not selling the goods. You have sent the goods for exhibition, export. After exhibition is over, what you will do? You will bring it back. You will bring it back to India, re-import. Now, when you send the goods for exhibition, obviously you will not take any export benefits. When you bring it back, just think logically, whether there should be any import duty? No. There won't be any import duty. There won't be any import duty. There won't be any. India also wants their businessmen to make presence felt outside India. So they'll also promote their businessmen to go outside and display their goods. And that will finally result into export order. As of now, you're taking for exhibition, showing them. If they like it, they'll purchase it. Then that is export. That will never be brought back. What will be brought back, by the way? If you take 100 units outside, 20 units are sold there. Are we concerned with 20 units? No. Our concern is with 80 units. No need of paying import duty. But for all these three, if you see the scenarios now, what was the first scenario? Sale, sale return. Export, re-import. Second scenario, purchase, that is import. Send it back for repairs, export, and bring it back after repairs, re-import. Third scenario, sending for exhibition, export, bring it back after exhibition is over, re-import. In the first scenario, they talk about what? They talk about what will be the duty. What will be the duty? Lower of actual import duty or export benefits. In the second scenario, they don't talk about duty, they talk about what will be the value. What will be the value? Whatever is happening outside India will be the value. In the third scenario, they tell that, okay, it is fully exempted. It is fully exempted. But please understand that whether it is situation 1, 2 or 3, there are common conditions. What are the common conditions? The moment it is going outside, it should come back within 3 years plus 2 years extension. Owner should remain the same, goods should remain the same. Owner should remain the same, goods should remain the same. And Any of these three benefits, whatever exemption we have discussed will not be applicable in all these cases. Whatever three exemptions we have discussed will not be applicable in these cases. What are these cases? If at all the goods was exported by EOU or a free trade zone, not FTP, a free trade zone, which includes SEZ, a free trade zone. If at all the goods were exported by EOU or a free trade zone, or if the goods were imported and exported by, not imported, exported by public warehouse or private warehouse, or if you're talking about petroleum and tobacco products, which is there in 4th schedule of your Central Excise Act. Central Excise Act is no more there, but excise is still there on certain items. Back to basics. Your Central Excise duty is still there on certain items. Recollect those items. Recollect those items. Permanently outside GST. Liquor. There you don't have Central Excise duty. Temporarily outside GST. 5. So you have petroleum products. Excise will be there. Then inside as well as outside GST. Tobacco. So you are talking about your petroleum products and tobacco products where Central Excise duty is there. Where? So they are demotivating re-import of petroleum and tobacco products. They don't want re-import of tobacco and petroleum. The logic of telling that the benefit will not be given for tobacco and petroleum products is they don't want re-import of tobacco and petroleum products. But what is the logic of first 2 points? When the goods are exported by your EOU or special economic zone, or goods are exported from public warehouse or private warehouse, first time import duty was never paid. There's no need of any relaxation. See, when they are exporting, they would have imported earlier. They are all tax free. They got the goods tax free. They got the goods tax free. I'll give a practical scenario to make you explain, understand this. I have a unit in SEZ as well as domestic tariff area. Initially, the goods were imported in SEZ. No import duty. It is exempted. It is exempted. The goods were sent back. Second time when the same item was imported, it was imported by domestic tariff area. Should I pay import duty? Yes. Fully? Yes. Any of these exemption? No. Another example. Initially, I imported the goods and kept in public warehouse and private warehouse. Did I pay the duty? No. Did I clear the goods? No. There was some problem. I had sent it back to outside India. After the work was done, I imported back. This time I did not took the goods to warehouse. I cleared the goods for home consumption. Should I pay import duty? Yes. Full import duty? Yes. Will I be given any exemption? No. There's no need. There's no need for exemption because there was no relaxation earlier. There was no relaxation. There was no duty earlier. Already when first time import was done, there was never any import duty payment. So second time import when it is done, not by them but by other people of the same company, BT of the same company, or now this time cleared for home consumption by the same company, I cannot take the benefit of this exemption. Otherwise, I will be trying to misuse. I will misuse this provision. Right. Now, when you talk about another exemption which is given in 158 bar 95. It is exactly opposite of the second exemption given in 45 bar 2017. Exactly opposite. What was the second situation there? You imported, you send it back for repass, you re-exported, you re-imported. Import, export, re-import. Purchase, send it for repass, bring it back. Here it is ulta. Here what is happening? There was sale, export. The customer outside India said that there's a problem with the product. The customer outside India said that there's a problem with the product. So, the goods are brought back to India for repairs or remanufacturing. Here, repairs is allowed, even remanufacturing is allowed. So, now it is re-imported. After you correct the mistake, after you do your repairs or after you do your remanufacturing, here both is allowed. There only repairs was allowed, but here repairs is allowed, remanufacturing is allow. You send it back. You send it back. You send it back after repass or remanufacturing. That is re-export. By the way, this situation is there also in your place of supply section 13. Performance based on goods. Exactly the same scenario. Exactly. Ditto the same scenario. When you exported the goods, you would have taken export benefits. You would have taken export benefits. No issues. When you are importing the goods, when you are technically you should pay import duty. Technically you should pay import duty. They tell that don't pay import duty. They tell that don't pay import duty. No need to pay import duty. Why? Even if you pay import duty, when you take the goods back, you will be claiming duty drawback. When you take the goods back, you will be claiming. So don't claim import, don't pay import duty, no need of duty drawback. There is no requirement of you paying import duty, then again going there. In addition to it, if you recollect your GST, place of supply provision, section 13, you are doing some repairs or remanufacturing, you may charge it. Now it is not about goods, import of goods, it is about your repair service or remanufacturing service. Now, place of supply of that in accordance with section 13, 5, which gives back reference to section 13, subsection 2, will be location of recipient, which will be equal to outside India, which means it will be treated as export of services, which means there won't be any IGC. So there is no import duty in customs and there is no GST even for your repair work in GST. Even for your repair work in GST. Ditto same situation was there in your section 13. Copy paste, same situation. You have exported it, now bring it back for doing some repairs or remanufacturing. You do your work and send it back. You do your work and if at all you pay any duty in India, again at the time of export you will be taking the benefit. So don't pay import duty, don't pay GST, no question of duty drawback, no question of refund in GST. No question of refund in nothing. This is the entire concept of your section of your notification 158/95. Just understand this concept of destination based consumption tax was right there from the beginning in India taxation. So you are talking about a notification which belongs to the year 1995. The concept was always the same. Now what is happening? What is happening? You have exported your goods which are manufactured in India. There is a problem with the goods. There is a problem with the goods. The goods are re-imported. Re-importation can be for repairs, reconditioning, basic work. It can also be for reprocessing, refining, remaking, manufacturing also. Both are covered here. Unlike the previous exemption, now both are covered here. Normal work, full work. Repairs, reconditioning is normal work. Refining, remaking, reprocessing is to redo the entire manufacture. To redo the entire manufacture. All you have to satisfy is you satisfy certain condition. If at all it is for repairs and reconditioning, the goods should have been imported within 3 years. 10 years for Nepal. Special relaxation for sister country. I don't know why Bhutan is left. Normally Nepal and Bhutan comes together, but here it is only Nepal. Think of it. Repairs may take time, but when the product itself was faulty, and when the customer of yours is telling that this item that you have sent is not at all working, you have to remanufacture it. Whether to identify that you require 3 years? No. You re-import within 1 year. Don't try to by-heart it. When the goods or machine is going there, if it is functioning, then repairs may come at some later point of time. 3 years, 10 years in case of Nepal. But if you have sent the machinery, the moment you see the machine, there is some fault with the machinery. Whether the customer of yours outside India will take 3 years time, he'll send it immediately. And the time limit is 1 year. And the time limit is, so re-importation is 3 years if it is repairs and 1 year if it is remanufacture. Basic thing. 3 years and 1 year. And when you bring it back, don't you think that you are required to do your work quickly? You are required to do your work quickly. Make sure that whether it is repair or remanufacturing, that is repairs, reconditioning or remaking, refining, reprocessing, do your work within 6 months plus 6 months. For repair, 6 months is sufficient. At time for remanufacturing, you may require an extension, therefore 6 months plus 6 months. After you import, 6 months plus 6 months. And when you re-export, there are certain conditions to be satisfied. You satisfy your assistant commissioner, deputy commissioner that the goods are the same. That the goods are the, what was imported is only going out. You prove it. Otherwise, in this process, you will try to some other item, sell some other item. You prove that ACDC, that the goods are the same. But understand that when you're basically doing remanufacturing, that is refining, remaking, reprocessing, there may be some loss. Assuming that you exported biscuits, you are re-importing biscuits because they were damaged. Now when you're remanufacturing it or remaking it, you might not have the exact same quantity that you imported. So if there is a normal loss, because you have remanufactured it, that will be ignored by ACDC. That will be ignored by ACDC. Now also understand that as you are promising that you will be exporting in next 6 months plus 6 months, whenever you make a promise, that should be along with the bond. When you re-import, you are getting the benefit of not paying the import duty. But who knows whether you re-export within 6 months plus 6 months. So at the time of re-importation, when you are not paying import duty, give a bond. Give a bond telling that I promise that I'll do my work and send it the goods back within 6 months plus 6 months extension. And if that this last point we have discussed, if there is any loss because of reprocessing, refining, remaking, such loss may be exempted. Such loss may be exempted. This point is repeated here also. Such loss may be exempted because the quantity that was imported and the quantity that is going out is very, that's the difference, but the difference is very minimum. And the difference is because of natural manufacturing loss. Right? It is because of normal loss. In your costing language, it is because of normal loss. That will be ignored. That will be ignored. Bring it back within 3 years or 1 year. Send it back in all the cases 6 plus 6. When you are bringing it back, give a bond. When you are sending it back, satisfy ACDC with the identity, and if there is a normal loss, convince ACDC that why this normal loss has come. Convince ACDC why this normal loss has. That is all about your notification 158/95. Now, this completes your normal charging section, section 12, special charging section, section 20 and 21, read along with notification 45/2017, 3 situations, and 158/95, 1 situation. Only 1 situation. Now you are talking about exception to the charging section. Exceptions to the charging section. In this entire chapter, that notification 45/2017, second scenario was very important, and the next important scenario is all these exceptions. All these exceptions, different situations. Section 13 talks about pilferage loss. Pilferage loss. What is pilferage loss? Petty loss. Petty loss. Theft in small quantities. Theft in small quantities. Theft in small quantities. Now, let me produce this in a very different manner. Supposing you are talking about pilferage loss, you are talking about petty thefts. Petty thefts covered in section 13. A comparative term is there in section 23(1). A comparative term is there in your section 23 subsection 1. That is a comparative term. Now what is that comparative term? You are talking about total loss or major loss. Total loss or major loss. Both are mutually exclusive. If it is petty loss, you can come and take the benefit of only section 13. If it is total loss, major loss, you can only go for section 23 subsection 1. Whereas section 23 subsection 1 talks about one more thing. What is that one more thing? Destruction. What is that one more thing? Destruction. Destruction of goods. And corresponding to destruction, there is something called as deteriorated goods or damaged goods. Deteriorated goods or damaged goods, which is there given in section 22. For deteriorated goods or damaged goods. For deteriorated goods or damaged goods, you go for abatement, which means reducing the value. For total loss, major loss, or for destruction, you go for remission, begging the department, telling that please forgive me my import duty. Please forgive my import duty. Then there is something called as relinquishment of title or surrendering the title, which is given in your section 23 subsection 2, read along with section 68. Read along with section 68. Relinquishment of title or surrendering of title. Then finally you have something called as denaturing or mutilation, changing the nature, which is there in section 24. What are comparators? Pilferage loss, total loss, major loss. Pilferage loss means loss in small quantity. Total loss, major loss means it is not in small quantities. It is not in small quantities. It is a major loss. It may not be always total loss, but it should be major loss. It should be, both are mutually exclusive. Either you are covered in 13 or you are covered in 23(1). You are not covered in both. Mutually exclusive. Then other comparative terms: deterioration, damage, destruction. Deterioration, the quality is reduced. Damage, there is a physical damage. Destruction, the goods are not at all there. It is gone. The goods are not at all there. It is gone. Then there is something called as relinquishment of title, giving up the title. The goods will be there, maybe in a good condition or not in a good condition, but you want to give up the title. And finally, a very separate concept called as denaturing or mutilation. Denaturing or mutilation. For petty loss, in all the cases, levy is there. In all the cases, levy is there. In all the cases, you do have levy. You do have levy. Levy is not relaxed anywhere. You do have levy. We are only talking about collection. Our focus is only on whether levy is present in all the cases. Levy is clearly present in all the cases. It's only about collection. In case of pilferage loss, that is petty loss, what will happen? Importer will not pay. On that small loss, supposing 1 lakh units are imported, 100 units are lost. Importer will not pay on 100 units. He'll pay on 99,900 units. Importer will not pay. Custodian may pay. Custodian as appointed as per other laws. Custodian appointed by commissioner. If it is custodian appointed by other laws, say for example, collector is appointed as the custodian, even custodian will not pay. If it is custodian appointed by commissioner, customs commissioner, custodian will pay. So when you talk about your pilferage loss, what was the example? You imported 1 lakh units. You imported and you are clearing 99,900 units. There is no doubt with respect to 99,900 units because you have to pay import duty on 99,900 units. What about 100 units? Importer will not pay. Importer will not pay. Custodian may or may not pay. If custodian is appointed under other law, no. If custodian is appointed by commissioner under Customs Act, yes, custodian will pay on 100 units in the second case. What about damage or deterioration? What about damage or deterioration? Whether there will be payment. Whether there will be payment. Yes. Yes. There will be payment. But there will be payment on a lesser value. Assume that the original value of the goods was 10 lakhs and customs duty. And your customs duty, which is, will take only BCD. BCD at 10%. BCD at 10%. What would have been BCD at 10% by the way? 1 lakh. If value is 10 lakhs, BCD at 10% would have been 1 lakh. Now, you are claiming that the goods are deteriorated or the goods are damaged, which means quality is reduced or that's a physical damage, obviously that also will result into value being decreasing. Now, on that lesser value, assume that the value has become 7 lakhs. You are going to pay the exporter of other country 10 lakhs, but the value of that is only 7 lakhs after deterioration or damage. What to do? Pay import duty on 7 lakhs, not on 10 lakhs. Not on, what will be the import duty that you will pay? You will not pay 1 lakh, you will pay 70,000. How you got that 70,000? Cross multiplication. So they give a formula which is telling that value after damage deterioration divided by value before damage deterioration multiplied by duty before damage deterioration. Cross multiplication. If you get a question directly, you can find out the answer without even seeing the formula. Cross multiplication. But you should have a doubt that who will decide this 7 lakhs? Who will decide? The goods are damaged, deteriorated, but who will decide that the goods value has become 7 lakhs? They tell initially that proper officer will decide what is the value. But if you are not satisfied, with the value set by the proper officer, what you can do? You can ask the officer to sell the goods by way of public auction, tender, or any other manner with your consent. If proper officer gives you a value which you are not convinced, if proper officer tells that it's 9,50,000 and you are telling that no, there's no only 50,000 reduction is not that. So what do? You tell proper officer, okay, you sell the goods on my behalf. Right? Either by way of public auction, tender, or any other manner. And after you sell the goods, you will get cross sale proceeds. You will get gross sale proceeds that will be taken as this value, not the net sale proceeds. It is the gross sale proceeds because you are trying to find out the worth of the goods at that point of time, at the time of input. Right. That is when you talk about your damage or deterioration, the calculation part. What about total loss or major loss or destruction? Here you will go and beg the assistant commissioner, deputy commissioner, telling that please don't ask any import duty because the goods are already lost or already destroyed. Please don't ask any import duty. You will make a remission application. You will make a remission application to ACDC. And when you make a remission application, you will give the corresponding proofs telling that there is a total loss or major loss of the goods. Say for example, it is destroyed by fire, loss or destroyed by fire. Give the proof. Either the FIR copy or the insurance claim, give the proof. No import duty. What about relinquishment of title? Here also, you will not pay any import duty. You will give your title to commissioner. You will go to the commissioner. This time you are not going to go to ACDC. You will go directly to Commissioner of Customs and tell that take this title of goods. Take this ownership of goods. I don't want these goods. This title can be given for any reason. You need not explain the reason. There's no requirement for you to tell why you have given up the title. One of the reason for you giving up the title is the market value has tremendously come down, or the goods are deteriorated, or the goods are damaged, or the goods received are not that you have asked for. No, it is the deterioration, damage is again coming here. Possible. Understand, if you want the goods, you go for abatement under section 22. If you are not interested in goods, you go for relinquishment of title, section 23 to subsection 2 or section 68. You do your cost benefit analysis. Then decide whether to pay lesser import duty and clear the goods for damaged and deteriorated goods, or whether to give up the goods and no question of any payment. No question of any payment. And finally, when you're talking about your denaturing mutilation, you are going to pay import duty on the changed product. On the changed product. If at all you imported second hand machinery, but you are telling the officer that no, I am going to use it as waste and scrap. Officer will tell that no, you imported second hand machinery, pay rate of duty on second hand machinery. But you are telling that no, I am going to use it as waste and scrap. So in front of the officer, destroy or totally de-erect the plant and machinery, convert that into waste and scrap, clear waste and scrap. From customs station, you clear waste and scrap. You do that in front of the officer. That is mutilation. Denaturing. If you bring any liquid item where the nature is different, say for example raw alcohol, and you're telling that no, don't treat it as raw alcohol, don't apply the rate of duty of raw alcohol, apply the rate of duty of industrial alcohol. But officer tells that in front of me, what is there? Raw alcohol. Why should I apply the rate of duty of industrial alcohol, which is a lesser rate? In front of the officer, change the nature of raw alcohol to industrial alcohol. In front of the officer, do that. Then clear industrial alcohol, pay duty on industrial alcohol. Look at this transaction, very special transaction. You imported second hand machinery, but what you are clearing from customs is waste and scrap. Technically speaking, you are liable to pay import duty on second hand machinery, but because of 24, you end up paying duty on waste and scrap. Second example, you imported raw alcohol, but what you are clearing from customs is industrial alcohol. Technically speaking, you have to pay import duty only on raw alcohol, but in front of the officer, you converted that raw alcohol into industrial alcohol. Now you are taking industrial alcohol, you are paying duty on industrial alcohol. That is because of section 24. That is because of section 24. This is the meaning of all these items and the main points of all these items. Are you guys clear with this entire understanding? Right, starting from your pilferage, loss to damaged goods, deteriorated goods, for which you will go for abatement, total loss, major loss or destruction, for which you will go for remission, relinquishment of title, then you have denaturing mutilation. I am not writing the sections again, we have already discussed that. Now certain other points. Pilferage loss is your right. You need not tell anything else. You just prove pilferage loss and take the benefit. Importer will tell that I will not pay import duty on 100 units, it is my right. I will not explain it further. Whereas when you talk about damage, deterioration, abatement is not your right, it is based on your request. You will give permission, you will give application to ACDC. Even remission application, total loss, major loss or destruction is based on request, In both the cases, request will go to Assistant Commissioner, Deputy Commissioner. Whereas relinquishment of title is your right. Obviously, you will give intimation to the Commissioner. Intimation, no permission. Intimation to the Commissioner. Denaturing mutilation, is it your right or request? Just like that, in front of the officer, you will go and break the second hand machine into waste and scrap. Just like that, you will enter customs station and convert raw alcohol into industrial alcohol, or it is based on request? It is based on? So only two things are based on your right: pilferage loss and your relinquishment of title. Pilferage loss and your relinquishment of title. Pilferage loss and your relinquishment of title. Now also understand that when you talk about the timeline where these should happen, all these things should happen before you are taking the goods for home consumption. Pilferage loss should happen after unloading of goods, before order of proper officer, either for home consumption or for warehousing under section 46. Before order of proper officer for home consumption or warehousing. Put in simple terms, It should happen at customs station. It should happen at customs station. Customs station. Damage, deterioration. Damage, deterioration. Things are separate for damage and things are separate for deterioration. I'll make life simple. Pilferage loss. Pilferage loss. The place where it should happen is only customs station. If pilferage loss happens at customs warehouse, you will not get any benefit. You have to pay the import duty. You have to pay the import duty. Now, when you talk about damage and deterioration, damage and deterioration, things are separate for damage and things are separate for deterioration. So first let us understand deterioration, then let us understand damage. For deterioration, it should happen before even the goods are taken in customs station. Before unloading at customs station. It is neither allowed when it is happening at customs station nor allowed when it is happening at customs warehouse. It should be before unloading. Before unloading at customs station. You will find out that it has happened after unloading. But deterioration should have happened before. See, both are different. Only after unloading you will see that the goods are deteriorated. But that deterioration should have happened before unloading. It should not happen when the goods were at customs station. Why? Do you know the goods are perishable goods? If you keep for some more time, it will be getting deteriorated. So deterioration should happen, which is there without your control. What is not in your control? Before unloading. After unloading, if deterioration happens, it is your mistake. It is your mistake. You came late. Whereas when you talk about damage, or when you talk about remission for total loss, major loss or destruction, or when you talk about relinquishment, or when you talk about your denaturing mutilation, this can happen either at customs station or at customs warehouse. Look at the understanding. Normally all the benefits are allowed both at customs station or at customs warehouse. Before you are clearing the goods. So you can go for a mission at customs station, even at customs warehouse. You can go for relinquishment at customs station or at customs warehouse. You can go for denaturing mutilation at customs station or at customs warehouse. But when you are talking about damage, you can even go for damage. You can even go for abatement of damage at customs station, at customs warehouse. Even for damage, you can go for customs station or customs warehouse. What is the point which is different? For deterioration, it should be before unloading at customs station. And when you talk about pilferage loss, allowed only at customs station. For deterioration, it should be even before unloading at customs station. You will find after unloading, but it should have happened before unloading at customs station. Pilferage loss should happen only in customs station, not in customs warehouse. All others, abatement for damage, remission for total loss, major loss, remission for destruction, relinquishment of title, denaturing, mutilation, it can happen both at customs station or at customs warehouse before you are taking your goods. That is everything about all these concepts. Now certain small points, one or two small points. Pilferage loss, if the pilfered goods are again returned back to you, pay import duty. If the lost goods are again returned back to you, pay import duty. The loss, small loss which was there, it is returned back, pay import duty. That is with respect to your pilferage loss. Now a small point with respect to your relinquishment of title. The benefit of relinquishment of title will not be given if you have committed an offence under any law. The moment you have committed an offence under any law, you will not be allowed to take the benefit of relinquishment of title. The moment you have committed an offence under any law, though it is your right, you cannot tell. If at all you are smuggling the goods and you are caught, you cannot tell that no, you take the goods. Relinquishment of title is not allowed if you have committed an offence under any law. And once the goods are relinquished, you cannot take it back. You don't play games with customs department. Take the goods today, and tomorrow tell that, no, please return my goods. No, that's not possible. That's not possible. Right. These are the special points that you need to remember for your, one was for pilferage loss and 2 points were there for your relinquishment of title. Relinquishment of title. So this completes your entire understanding with respect to your levy of customs. Be it section 12, the normal charging section, be it section 20, 21, special charging sections or clarification to charging section, or be it 13, 22, 23, 1, 23, 2, section 68, even your section 24. These are all your special provisions. Now, when you talk about your customs valuation, the entire concept of customs valuation is discussed in your section 14. Section 14.1 talks about your transaction value, and then section 14.2 talks about your tariff value. And remember one thing, whenever you're finding value, this value will be basically used only and only for the purpose of BCD. Then for other duties, the value will not be exactly the same, it will be differing. So this valuation is only and only for BCD. Obviously, it will be helpful for other duties also. The foundation will be this, but most importantly, it will be only for your BCD purposes. So you talk about your two types of valuation. One is your tariff value, which is given by CBIC, which means irrespective of the transaction value that you deal with, whether you are importing for 1 lakh or 1.5 lakhs or 1,20,000, if the tariff value is freezed as 1,30,000, that will be taken as the value. So value for notified goods, will always be only tariff value, which means they'll ignore your transaction value. They'll go with the tariff value given by CBIC. Now, before I go ahead, please understand that we'll first try to understand valuation only for import purposes. The moment we complete valuation for import purposes, the very simple differentiation chart is sufficient to make you understand the valuation of export. So our entire focus is to find out value for imported goods. In imported, and the same concept will be there even for export goods with some changes that we'll discuss in the end. So when you talk about valuation, section 14.2 valuation, special valuation is there only for notified goods, where government is not going to see your transaction value. It will tell that whether you import for price X or price Y or price Z, we have said that this is the value. 1,30,000 is the tariff value. You go with 1,30,000. Obviously for a particular number of units. If the units increases, that will change. Now, what is the normal valuation? Normal valuation in your customs is your transaction valuation. Other than notified goods, it is your transaction valuation. By the way, in GST, you don't have the concept of tariff value. Directly, you have the concept only of transaction value. In customs, main valuation is transaction value, but for notified goods, it can be your tariff value. So let us focus on the main valuation, which is transaction value, For you to be covered under transaction value, you are required to satisfy certain conditions. There are totally section 14, 4 conditions. Section 14, 4 conditions. Rule 3, another 4 conditions. Then you have something called as last 2 conditions, which is your valuation declaration and rejection. So it is 4 plus 4 plus 2. For you to be covered under rule 3, you have to go with 4 plus 4 plus 2 conditions. 4 plus 4 plus 2 conditions. Now, before I take those conditions, understand in GST, if you satisfy the conditions in GST, you have the concept only and only of transaction value. Here you have tariff value at times. Mainly it is transaction value. Mainly it is transaction value. Now we are talking about the differences when it is transaction value in GST. If you satisfy the three conditions of section 15, then you need not refer valuation rules. Correct? With the three conditions, price is a sole consideration, unrelated party transaction, not a special case. You need not refer to valuation rules. But in customs, how many conditions are there? 4 plus 2 conditions. Even if you satisfy all the conditions, still you have to see valuation rules. Because the main answer in customs is given in terms of rule 3, which is your transaction value. Then it is rule 4, 5, 7, 8, 9. Right. So a clear-cut difference is seen that in GST, if all the conditions are satisfied, there is no need to see valuation rules. Whereas in customs, even if you satisfy all the 10 conditions, 4 plus 2, still you are required to see valuation rules. In GST, if at all you are seeing valuation rules, if at all the conditions are not satisfied, obviously you have to see the valuation rules. You don't apply the rules in sequence. It is either 27 or 28 or 29. Then here you apply the sequence 30, 31. Correct? The rules are not applied in sequence. The rules are applied based on situations. But here the rules are applied in sequence. The rules are applied in sequence. First, you have to try. First, you have to write rule 3. If not, go to rule 4. If not, rule 5. If not, rule 7. If not, rule 8. If not, rule 9. You have to apply the rules in sequence. So always our focus will be first only on the main rule, which is rule 3. Valuation is always under rules. Your valuation is always under rules. Now talking about rule 3. Now what we are trying to understand, rule 3 conditions. How many conditions are there? 4 plus 2. What are the first 4 conditions? That should be sale. What are the first 4 conditions? That should be sale transaction. Second, delivery should be at the place of importation. Should be at the place of importation, which means India. At the time of import, where is the place of importation? India. And because of this, your imports are always valued at CIF. Cost plus insurance plus freight, because delivery should be at the place of importation, India. Cost when the goods are sent from outside India, plus insurance and freight when the goods are touching India. Third, buyer and seller should not be related. We have discussed the definition of related person of customs, right, when we have seen GST. Related person of GST, make 2 changes. 25% to 5%. Another change in GST, sole agent is by default treated as related person, but here by default he is not treated as related person unless otherwise he is covered. Fourth, price is the, so if you see third and fourth, it is the same. Unrelated party transaction, price is the sole consideration. What is extra given? The transaction should be that of sale. Because when you talk about import and export, it need not be actually a sale transaction. I can get the goods from outside India as a gift, or I can get the goods from outside India as free samples, or I can get the goods from outside India acting as an agent of foreign supplier. There is no sale. But here they tell that if you want to come in main rule, rule 3, there should be sale transaction. Delivery should be at place of importation, that is India. Unrelated party transaction and price being the sole consideration. Now, once you satisfy all these 4 conditions, it is not satisfactory. First, you have to satisfy these 4 conditions. Next, you have to satisfy another 4 conditions. What are the another 4 conditions? The sale which is there should be unrestricted sale. There should not be any restriction. What are the first 4 conditions? Sale, place of importation, unrelated, sole consideration. Now, next 4 conditions are given in rule 3. That sale which we are talking about should be unrestricted sale. The sale that we are talking about should be unconditional. It should be unrestricted. It should be unconditional. This is your 5th condition. This is your 6th condition. 7th condition. If there is any subsequent sale proceeds, you should be in a position to quantify what is that amount. If you are going to get partial sale, if at all, as an importer, you are paying one amount now and balance proceeds you will be paying later. You should be able to quantify what is the balance amount that you are going to pay later. Subsequent proceeds should be quantifiable. 8th. Again, they tell that the transaction should be between unrelated person. The transaction should be between unrelated person. Now you may wonder why it is again repeated. We'll see that. This condition is again repeated. Now let us try to understand the detailed part of your 5th, 6th, 7th thing. First 4 condition, nothing more. That's it. There should be sale, nothing more. Delivery should be at India, place of importation, CA value, nothing more. Unrelated person, nothing more. Sole consideration, nothing more. Now 5th condition, what is the 5th condition? In all these 5, 6, 7, 8 cases, there is a possibility that though you don't satisfy this condition, but still you are inside. Let us try to understand that. Unrestricted sales. If there is any restriction, what will happen? The moment there is a restriction, you are going to go to rule 4, rule 5, rule 7, rule 8, rule 9. You are thrown outside rule 3. You have to go as per rule 4, 5, 7, 8, 9. No 6. Rule 4, 5, 7, 8, 9. But then they give an exception. Wait. We'll give an exception. Now what is that exception? If there is a restriction which is by way of law or public authority, which means it is mandatory restriction. It is imposed by way of law or public authority. The exporter of outside India is not putting his own restriction. It is because of the law or public authority that restriction is there. By the way, understand that in all this and entire discussion, I will be the importer in India and as an exporter in USA. So that exporter of USA has put a restriction, but it is required as per law or public authority. Nothing to be done. I will still remain in rule 3. Or that exporter of outside India has put a restriction on me, geographical restriction. He is telling me, the importer of India, telling that your territory is only Tamil Nadu. You don't sell outside Tamil Nadu. That's a geographical restriction. There is a restriction but based on area. Nothing. No need to worry, be under rule 3. Or there is any other restriction which is not affecting the value. The exporter of USA is telling me that you don't reveal these goods till 1st of January. You import and keep the goods. Keep it a secret. This is very common with automobiles. Very, very common with your mobile phones. Especially when you talk about, say, a particular brand, MI mobile phones. Right? They will try Apple. I should tell this example. iPhone. I don't know what is there in iPhone other than I. Right? Nothing special is there. Ask the users of iPhone, they will not be able to explain. They will fumble while explaining what are the benefits of iPhone. Don't worry, I was one of the users. I have given up. You don't know what are the benefits. And surprisingly, you will find people standing in line for days together, hours together, 36 hours. Recently, person was standing just to get the new version of iPhone 15. I don't know what. And he fought with the salesman. Excellent. That is only a tactics to create a demand. That item would have been imported long back, but they'll tell the importer, don't sell it before a particular date. That is a restriction, but is it affecting the value? No. In all these three exceptions, even though there is a restriction, you will remain in rule 3. You will remain in rule 3. That is condition number 5 for you. Condition number 6. There should be unconditional sale. There should be unconditional sale. If at all there is a condition for which there is no value, no worry, be here. If at all there is a condition for which there is a value which you can find out, don't worry. Don't worry. Be in rule 3. Then what is the problem? If at all there is a condition for which you are not able to find out the value, only in that case, go to rule 4, 5, 7, 8, 9 in that sequence. Having a condition is not a problem. If the condition value is 0, nothing to worry, be in rule 3. If the condition value is some value, but you are able to quantify it, be in rule 3. If there is a condition which you are not able to quantify, then go to rule 4, 5, 7, 8, 9. Now next, if subsequent sale proceeds are quantifiable at the time of import, if at all there is any subsequent sale proceeds which is quantifiable at the time of import, which you can quantify at the time of import, there will be an addition in terms of rule 10. The main rule of your valuation is rule 10, where you are going to add a lot of items, 5 plus 2 items. If you are able to know the value, supposing you are going to give a subsequent sale proceeds, which you know the value. Now I am going to pay 1 lakh. Later on I am going to pay 20,000. You know the value. Don't worry. Be in rule 3. But if there is a subsequent sale proceeds which are not quantifiable, assume that they are not quantifiable. If they are not quantifiable, you know that today I have to pay 1 lakh and I have to pay something later to the exporter of USA, something, but I am not able to find out that value now, because he might have said that pay me 10% of your proceeds after you sell. Now pay me 1 lakh, later on pay me 10% of the sale proceeds. I have not yet sold the goods. I am not in a position to find out today. I know at the time of import that the worth of the goods is not 1 lakh. Why? Now I am paying 1 lakh. Later on I have to pay something to the exporter of USA, which I am not in a position to quantify today. What to do? You are not in a position to quantify. Don't worry. Go to rule 4, 5, 6, 7, 8, 9. See, in all these conditions, you are finding one thing very common. You may remain in rule 3 at times, or you will be thrown outside rule 3 at times. Correct? If there is a restriction by law, public authority, geographical restriction not having any value effect, be in rule 3. Otherwise, go to 4 to 9. If there is a condition, value of which is 0 or value of which is quantifiable, be in rule 3. If not quantifiable, go to 4 to 9. If there is a subsequent sale proceeds which you can quantify now at the time of import, be in rule 3. Otherwise, go to 4 to 9. Related person. By default, you are talking about the moment it is a related party transaction. The moment it is a related party transaction, you are going to rule 4, 5, 7, 8, 9. But, if you prove that relationship has not influenced the price, remain in rule 3. If you prove that relationship has not influenced the price, your declared value is closely equal to identical goods value or similar goods value or detective value or computed value. All the different valuation rules. It is closely equal to the valuation rules which will come later on. Then don't go to later on rules. Be in rule 3. So here also, that is the reason it is repeated again. By default, if there is a relationship, you will go to 4, 5, 7, 8, 9. But if you prove that relationship has not influenced the price, remain in rule 3. Remain in rule 3. So these are the first 4 and the next 4 conditions. First 4 conditions are in terms of section 14, and next 4 conditions in terms of rule 3.2, and the last 2 conditions which are rule 11 and rule 12. Rule 11 and rule 12. What is rule 11 talking about? Rule 11 tells that as a C, you make a promise. You give a valuation declaration on your letter telling that the value that you have declared is full and accurate, true and accurate. And if at all you are asked for any other statement, information and document, please produce it. So assessee is giving a valuation declaration telling that whatever value I am declaring is true and accurate, is true and accurate. And if at all you are being called for giving any statement, information or document later on, that will be given by the importer. That is rule 11. Valuation declaration by the importer. Then what is rule 12? Rule 12 is a rule which will give the powers to the proper officer to reject the value under rule 3 and to start 4, 5, 7, 8, 9. Now proper officer, if he is satisfied with the truth and accuracy of the value, valuation will be as per rule 3. But if proper officer is not satisfied with the truth and accuracy of the value, then he'll call for information, documents or evidence from the importer. After seeing the evidence, if he is satisfied, still it will remain in rule 3. If proper officer is not satisfied with truth and accuracy and he is calling for documents, information and evidence, even after seeing the documents, information, evidence, if he is not satisfied or there is no response, then you will start 4, 5, 7, 8, 9. Then you will start 4, 5, 7, 8, 9. And before rejecting the value, there will be an opportunity of being heard given to the assessee. And if at all, importer is telling me that give me the reasons in writing, officer has to give the reasons in writing. Importer can demand the reasons to be written in writing why my value is rejected under rule 3, and officer shall write the reasons in writing why he has rejected the value from rule 3 and why he has gone for 4, 5, 7, 8, 9. That's your rule 11 and rule 12. And they talk about certain special points in rule 12. Why will officer have a doubt? Why at the first instance officer is having a doubt? Either officer sees the goods, your goods are called as subject goods. Officer sees other goods, identical goods, similar goods, and sees your goods you have imported at 1 crore. But identical goods, similar goods have been imported for 1.5 crores. You are showing your import value as 1 crore. At the same time, some other person has imported the same identical goods or somewhat similar goods for 1.5 crore, same quantity, same everything. There will be a doubt in the minds of proper officer. Or you are getting a very abnormal discount from your exporter of USA. Or you are getting a very special discount, which means abnormal discount or special discount, which means again your value is lesser. Your value is, the problem with import is always undervaluation. The problem with import is always undervaluation. Or you have declared something which is wrong, misdeclaration. You have declared something which is wrong. Or you have not declared something which was required to be filled up. Importantly, your quality, brand name and all will be required to be filled up. You are not filled up. Misdeclaration or non-declaration, or the document itself that you have submitted were all manipulated documents, fraudulent documents. These are only examples which will raise doubts in the minds of proper officer. Therefore, he will use the powers under rule 12, ask for additional documents, information and evidence. Even after calling for that, if he is not satisfied, he will reject the value under rule 3 and start with 4, 5, 7, 8, 9. 4, 5, 7, 8, 9. Now, please understand that rule 12 is not a valuation rule. It is only a rejection rule. Why I am telling this? Proper officer would have rejected your value using the powers in rule 12 because he saw that you have shown the value as 1 crore, but the identical goods were imported by someone else for 1.5 crores. Now this becomes very important to tell that he can reject this value under rule 12, but just by rejection 1.4 crores will not become the answer. Why he has rejected it? He saw your value 1 crore, he saw identical goods value 1.5 crores, he compared it. He has got the powers to reject based on that comparison, but after rejection 1.5 crores will not become the answer. He has to apply the rules in sequence. Then he has to go and apply 4 in detail, then 5 in detail, then 7, then 8, then 9 in that sequence. The basis on which the value was rejected by default will not become the answer, because rule 12 is not a valuation rule, it is a rejection rule. It is a rejection rule. And if the value is rejected here, you have to go as per sequence to next rule, 4, then 5, then 7, then 8, then 9. So that is an important point for you to understand when you're talking about rule 12. Also understand the fact that if I am able to convince the proper officer that my value is true and accurate, though that is a very special discount, officer shall accept it. I may have got a very, very special discount, but with documents, I prove that this value is a true and accurate value. Proper officer shall accept. Normally, other people are getting for 10 crores. I may have got for 7 crores. I prove why I have got for 7 crores. I give all the documents. Officer shall accept my declared value. He cannot tell that no, I have doubts. You had doubts. I explained. I gave all the details. I said why for others it is 10 crores and why for me it is 7 crores. I explained everything. After explanation, if proper officer is satisfied with truth and accuracy, he shall accept the declared value. Now, once you understand rule 3, the main rule is rule 3. The main rule is rule 3. All your questions will revolve around rule 3 read along with rule 10. All your questions will revolve around rule 3 read along with rule 10. Very rarely they will be touching 4, 5 is never touched. Might be they will be touching your 7, 8. Might be. The questions revolve only on rule 3, mainly not even rule 3. The conditions that we have discussed will not be so relevant. What is relevant is the additions. If you recall, in GST, if at all you are satisfying the conditions, your assessable value is equal to transaction value, which is equal to selling price plus service charges minus 2 things plus 5 things. In customs, it is rule 3. Assessable value is equal to transaction value. It is transaction value plus 5 plus 2. There is no minus. Plus 5 plus 2. Plus 5 plus 2. Plus 5 additions of rule 10.1 and plus 2 additions of rule 10.2. 5 additions of rule 10.1 and 2 additions of rule 10.2. Now what are the 5 additions? These will be the questions that in your question paper. We will be taking the points from these points. 5 additions of rule 10.1 and 2 additions of rule 10.2. Now what are the 5 additions? First addition, let us focus on rule 10.1a. It talks about commission and brokerage except buying commission. Your commission will be added but not buying commission. What is meant by buying commission? Buying commission means the commission paid by Indian importer. Indian, it may be paid to an agent outside India or in India. Don't decide on the basis of agent. Decide on the basis of who's paying. Buying commission means the commission which is paid by importer, whether to an agent in India or outside India. So the moment you get a commission in question, see carefully whether it is buying commission or selling commission. If it is selling commission, add it. Add it. If it is buying commission, don't add it. If nothing is given, by default treat it as selling commission. Add it. By default treat it as selling commission. Add it. So buying commission which is paid by the importer, whether to a broker in India or outside India, will not be added. Will not be added. Now, next addition is your cost of containers and cost of packing, whether material or labor, which means cost of containers and cost of packing, whether it is material or whether it is packing material or packing charges. Packing material cost or packing charges. So your cost of packing charges, your cost of packing material, your cost of container. Container is nothing but special packing. They all will be added. They all will be added. So if you get a question where there's a container cost, packing charges, add it. There's only one exception, one relaxation. What is that? If at all, this container belongs to a shipping line which you are clearing. Supposing you're importing glass. You're clearing the glass along with that container. So you're clearing the glass along with that container and you promise that you'll re-export within 6 months. You promise that you'll re-export within 6 months. Understand this fact. This container is not permanently coming inside India. It came, you'll unload the glass, you'll again give back the container. If at all you include this cost of containers and pay import duty, again when you send the containers, to that extent you will get duty drawback, not on the full import duty, but to the extent of container you will get duty drawback. Why to pay import duty? There is no question of import duty drawback. So what they tell, if the container is brought and promised to be re-exported within 6 months of import, then it will not be added, but someone has to give a bond. Because we are not adding it. By default it should be added. We are not adding it. Who has to give the bond? Shipping line has to give a bond, not the importer. Why? The importer will not have regular contact with the customs. Who will have regular contact with the customs? Shipping line. And by the way, these containers generally belongs to whom? Shipping line. So who has to give a bond? Importer is not required to give. Who is escaping import duty on container? Importer. But who has to give a bond? Shipping line. Who has to give a bond? And bond is always its security. Obviously, shipping line will tell the importer to give security. Though it will give a bond, but security generally shipping line will ask importer to give the security. It will not take risk on behalf of the importer. Right. So this is all about the first addition. Now there's a special point given here. Commission paid to canalizing agent. This in fact is not a commission. This we'll be discussing in the later part of the chapter. Rather, we have already discussed. I'll make it your life simple. I am importer 1. I have imported the goods. When the goods are at customs station, customs warehouse, I give you the title. I imported for 1 crore. I am giving the title for 1.2 crores. Who is going to pay the import duty? Importer 1 or importer 2? I imported the goods. The goods are in customs station or customs warehouse. They are not clear. I give you the title. I give you the title. So importer 1 is giving the title to importer 2. In terms of your customs act, who's the importer? Importer 1 or importer 2? Importer 2. Who will pay the import duty? Importer 2. Who will clear the goods for home consumption? Importer 2. On what value? 1 crore or 1.2 crores? 1.2 crores. That 20 lakhs is not commission. It is my profit. I had the title, then gave the title. I took the title, then gave the title. So this commission paid to canalizing agent which is given here, you can write that it is nothing but profit of importer 1. It is technically not commission. I am actually acting as canalizing agent. I imported, I gave you. I did not touch the goods. So in common language, you can call me as canalizing agent. But in reality, I am not the agent. Why? I purchased and I sold. I purchased, then I sold. I got the title, I gave the title. I acted like agent. Why? I never took the goods. I acted like agent, but I was technically not the agent. Who will pay the import duty? You rightly said something. Importer 2. Who is the importer as per Customs Act? Importer 2. Who will file bill of entry? Importer 2. Who will clear the goods? Importer 2. On what value? His value. What is this value? 1.2 crores. Will he tell that no, I'll pay only on 1 crore? No. He has to pay on 1.2 crores. He cannot remove 20 lakhs, telling it is commission. He cannot remove 20 lakhs, telling it is commission. Clear? It is only a clarification. It's only a clarification. If this was not said, answer would have been the same. You would have finally said that importer 2 will pay on his value. What is his purchase value? 1.2 crores. That's the answer. What is the clarification? Don't remove 20 lakhs. Don't call 20 lakhs as commission. It is not commission. It is profit of importer 1. What is the second addition? What is the second addition? The second addition is the case where I am the importer in India. I have supplied some goods or services to exporter of outside India. I am the buyer. I have given these goods or services free of charge or reduced price to the exporter of USA. I am the importer of India. I am going to import from USA, but I have sent some items from India to outside India. From India to outside India to the exporter of USA at a reduced value or a free of charge. Now understand that supposing that exporter of USA is going to manufacture and give me the shirt. Give me the shirt and assume that the shirt costs 500 rupees. He is going to sell me for 500 rupees. I tell him, no, you reduce it. I'll send the fabric. I'll send the fabric. So what was its price? The exporter of USA initially said that I'm going to give you the shirt for what price? Give you the shirt for what price? 500. I said that don't worry, I'll send you the fabric. I'll send you the fabric. I'm going to send you the fabric. So he started selling fabric. Then what is the price now? Say 250. Indian importer tells that don't worry, I'm also going to give you buttons and threads. Again the price reduces to say 230. Indian importer tells that don't worry, I'm also going to give you design. Also going to give you design directly by him or through some other country. Directly from India through some other country, I'm going to give you the design. Supposing the price reduces to say 200. Now he tells that don't worry, I'm also going to give you sewing machine, capital goods. Capital goods. Capital goods. Now the amount reduces to say one proportionate cost. We'll take it as say 130 rupees. Now, what is actually imported? What is actually imported? Shirt. Do you think that the shirt cost is 130? No. The cost of the shirt is not 130. 130 is a job working charges. Correct? Correct. So when you are importing the shirt, you have to pay import duty on 130 or 130 plus something. You are going to pay import duty on 130 plus all these values back to 500. Back to 500. That items that importer is supplying directly or indirectly, free of cost or a reduced price to the exporter of USA can be the main material components parts. It can be the main materials components parts, which is raw materials, or it can be materials consumed, which are consumables. In our example, fabric is the main raw material. Buttons and threads can be called as consumables, or it can be tools, dies, molds and other similar items, nothing but capital goods, or it can be services, any design plan sketches or any artwork, development work, engineering work, services. The moment you keep sending these items to exporter of USA, he keeps reducing the price, but when you get the product, you are not talking about the job working charges. Please understand that customs is only on goods. It's only on goods. You are trying to collect import duty on shirt, not on the job working charges of shirt. So how to tackle it? From 130 keep adding. From 130 keep adding all these amounts. Keep adding all these amounts. But one important point. When you talk about your materials or materials consumed or capital goods, materials or material consumed or capital goods, whether they are given from India or whether they are given from outside India, they will be added. They will be added. But when you talk about designs, if they are given from India, it will not be added. If they are given from outside India, it will be added. If design services are given from India to promote service sector in India, they don't do addition. If raw materials, materials consumed and capital goods are sent from India or outside India, addition will be done. But when you're talking about services, if it is sent from India, not added. If it is sent from outside India, that will be added. That will be added. And one more thing that you need to understand, when you talk about capital goods addition, it will be on proportionate basis. It will be on proportionate basis. Assume that importer has agreed to import 10,000 units. Importer of India has agreed to import 10,000 units. And as of now is importing 1,000 units. And total manufacturing till now has happened of 4,000 units. There are three quantities. The contract number of units is 10,000. Now what you are importing is only 1,000. The export of USA has already manufactured 4,000. Assume that importer of India has sent capital goods to exporter of USA. He has sent capital goods to exporter of USA. What will be the addition that you will do? Exporter of USA is charging only rupees 50 per unit, rupees 50 per unit for each of the units that has been dispatched. What is the contract unit? 10,000. What are the units that is already manufactured? 4,000. This is the contract units. This is already manufactured. What is actually imported now? 1,000. Find out the value. Find out the import price. First, forget about addition. What will be the basic transaction value, declared value? Then we will talk about addition. What will be the basic declared value? How many units are importing? So import duty as of now will be only on 1,000. So import duty will be only on 1,000 multiplied by 50 per unit. What is the answer? 50,000 rupees. Declared value as of now is only 50,000 rupees. There are three answers that you can, option 1, option 2, option 3. Now what is the addition that you will do? Assume that this importer of India has sent capital goods free of cost, the value of which is 10 lakhs. The value of which is 10 lakhs. You are going to add the proportionate cost of capital goods. Now you have three options. This 50,000 cannot be the final answer. Why? Because when importer of India sent capital goods for 10 lakhs free of cost to exporter of USA, he would have already reduced the price. The amount 50 rupees he is collecting, which is after reduction. Now add back. What amount to add? The value of capital goods. What is the value of capital goods that you will add? First answer, add entire 10 lakhs. Now itself add entire 10 lakhs. When balance 9,000 units are imported, don't add anything. When balance 9,000 units are imported, don't add anything. Second option, add 10 lakhs multiplied by how many units are imported now? How many total units will be imported? 10,000. So add now how much? Add now how much? Add now only 1 lakh. Add now only 1 lakh. When balance 9,000 units are imported, keep doing proportionate addition. Keep doing proportionate addition. Third option, add now 10 lakhs multiplied by 1,000 units that are imported divided by 4,000 units that you have manufactured, which means add now only 2,50,000. Add now 2,50,000. When balance 3,000 units are imported, do proportionate addition, and when final 6,000 units are imported, don't do proportionate addition. Don't do, because already it is amortized. These are the three variants we have. Either add the entire cost of capital goods at the time of first consignment, or add the apportioned cost of capital goods based on number of units imported divided by total contract units. Then later on, when the balance 9,000 units are imported, keep adding. In the first case, if you've added now itself, later on you are not going to add anything. Last option. Take this 10 lakhs, take 1000, divided by the manufactured units, not divided by total contract units, divided by manufactured units. Add now 2,50,000. When the balance 3,000 units are imported, which are already ready, do proportion addition. But thereafter, when the last 6,000 units are imported, don't do addition. The most logical calculation is the last calculation, practical calculation. First option is done only when you are expecting the rate to increase. When there is an expectation that import duty rate on this item will be increasing. Otherwise, first option will never give. Among second and third option, what is most logical calculation? It is second. It is not second, it is third. You might feel it is second, but in reality it is third. Why? You are very clear that these 4,000 units will be clearly imported. You are not sure whether balance, see the contract unit is 10,000. It might not happen that exact 10,000 units are manufactured. Correct? So there will be difficulty in calculation or some complex calculation in the end. What to do? Now you do pro rata calculation on the basis of 4,000. You are very sure that balance 3,000 units will be imported, and thereafter don't do any addition. Thereafter don't do any addition. This is for capital goods once ICI has touched it. Rare, but once ICI has touched the same, telling that how you are going to do proportionate addition for your capital goods. Next, you are talking about royalty and license fees, which are related to imported goods and as a condition of sale. As a condition of sale. For example, I am importing a machinery worth 10 crore rupees. And supposing this is very common with hospitals. I am importing a machinery worth say 10 crore rupees. To operate that machinery, I have to pay royalty or license fees to the person who has invented that machinery. So along with 10 crores, I am required to pay another 1 crore. So what will be my value for customs duty purposes? 10 crore plus 1 crore. Why? It is related to imported goods, condition number 1. It is part of condition of sale. When the supplier of USA, exporter of USA would have given this machinery, he would have clearly said, that you have to pay 10 crore plus 1 crore royalty. 10 crore plus 1 crore royalty or 10 crore plus 1 crore license fees. It is related to imported goods plus it is condition of sale. Plus it is condition of sale. Clear? But what if I don't pay license fees? I tell that this is very common with say books. I normally if I import say good novels, I have to pay say import price is say 100 rupees, then I have to pay 10 rupees royalty to the author. The publisher will tell that 100 rupees is the price plus 10 rupees royalty to the author. I have to pay import duty on 110 multiplied by the number of books. But what agreement I enter with the publisher, I tell, I am not ready for that. You give me a single book. You give me single book. I'll pay you lump sum 1 crore. I'll pay you lump sum 1 crore. I don't want lakhs of books. You give me a single book. I'll pay you lump sum 1 crore. What was the worth of that book? 100 plus 10. But how much I am paying now? 1 crore. That 1 crore is for what? Right of reproduction. I am telling the publisher, I will have the publishing rights in India. On that rights of reproduction, whether there will be any import duty? No. There will be GST. Import of services, there will be IGST. There will be IGST. There won't be any customs duty. Understand, the worth of that book is not 1 crore. The worth of the book still remains 110. Why I am paying an extra amount, which is a major amount? That is because of right of reproduction. That will attract IGST. It is import of services that will attract IGST. It is escaping customs. Don't worry. It will attract IGST. It will attract IGST. And when you talk about payments made by the importer for right to distribute or reselling that imported goods, which is not a condition of sale. Say for example, I import a machinery for 10 crore plus 1 crore, which is a royalty. I have to pay import duty on 11 crore. I have to pay import duty on 11 crore. 10 crore for the machinery and 1 crore the royalty or the license fees on the machinery. Both the conditions are satisfied. What are the conditions? Related to imported goods as a condition of sale. I have imported the machinery. I don't know how to use. I don't know how to use. I call that exporter of USA. Tell that please teach me how to use. They tell that you have to pay another royalty. You have to pay another royalty to know how to use it. To know how to use it. That another royalty is 50 lakhs. That another royalty is? Now tell me that whether that 50 lakhs will be added now? No. Why? That was not part of condition of sale. Don't worry. This 50 lakhs will attract IGST, import of services. If you recall your GST provisions, royalty and license fees that are included in customs is exempted from GST. That 1 crore is exempted from GST. 50 lakhs royalty. Second royalty. Royalty and license fees which is not exempted in, which is not included in customs, is not exempted in GST, that will attract IGST, import of services. So I have taken two royalties. 10 crore machinery value plus 1 crore main royalty. Condition of sale. Import duty will be on 11 crore. No IGST on 1 crore. Exempted. Another royalty 50 lakhs to know how to use it. To know it is not a part of condition of sale. Whether it will be added in customs valuation? No. Whether it is exempted from GST? No. I have to pay on 50 lakhs. Import of services? IGST. Import of services? IGST. Now, this point we have already discussed, subsequent sale proceeds. If at all there is a subsequent sale proceeds, if I am paying 1 crore now and I am going to pay 20 lakhs later, what will be the value? If I am paying to the exporter of USA 1 crore now, 20 lakhs later, what will be the value? 1 crore, 20 lakhs, because it is quantifiable at the time of import. But if I am paying 1 crore now and I have to pay something to the exporter of USA later, but I don't know that value. Don't worry about this particular point because you are thrown outside rule 3. You will go to 4, 5, 7, 8, 9. You will go to 4, 5, 7, 8, 9. Subsequent sale proceeds will be added. But understand, if the exporting company of USA is holding shares in importing company of India, that is me, I am deciding to give dividend. Whether that dividend will be added? Whether that dividend will be added? Clearly the dividend will not be added. Why? It has got nothing to do with import transaction. It has got nothing to do with import transaction. That dividend will not be added. And finally, the last addition in your rule 10.1, that is rule 10.1e, any other payments, residuary payments, which is made as a condition of sale of imported goods. Very important point, which should be made as a condition of sale of imported goods. Whether I pay to the exporter or third person on behalf of exporter. Similar thing is there in your GST. Payment by recipient to supplier or third party on behalf of supplier. But here there is an extra point. It should be as a condition of sale. It should be as a condition of sale. Please understand that in your residuary addition, few things will not be added. What are the few things which will not be added? If at all, payment is made for post-importation process, rather this you need to correct it. If payment is made for post-importation process as a condition of sale, it will be added. Normally, anything that you pay after importation will not be added. But anything that you pay after importation, but it was agreed at the time of sale, will be added. Please change it. Payment which is made for post-importation process, which was as a condition of sale, it will be added. I'll make your life simple. I have imported a second-hand machinery. I am paying 1 crore. The machinery is to be removed from, deinstalled from USA. For that I am paying 10 lakhs. right? That 10 lakhs I'm paying not to the seller, I'm paying to the engineer on behalf of seller. So how much, on what value I have to pay import duty? 1 crore plus 10 lakhs. Why? That 10 lakhs was a condition of sale. To sell that machinery has to be deinstalled. That machinery has to be deinstalled. Correct? Now that machinery comes to India. That machinery comes to India. I call the same engineer to install that machinery in India. Whether that will be added? Whether that will be added? No. Why? It is not a condition of sale. Let me change the example. That seller tells that I have great brand value. I cannot allow any person to install my machinery. So, you take my machinery for 1 crore plus 10 lakhs for deinstallation. You bring in India. I'll send my person to install it. It is my condition. The seller is very much concerned with the brand value. If you allow anyone else to install it, it may not work properly. Tomorrow my brand value will get decreased. Now, the installation was part of condition of sale. Machinery value is 1 crore, clear. Deinstallation 10 lakhs is part of condition of sale to be added. Installation 20 lakhs is also part of condition of sale. It's also part of condition of sale to be added. Though it is after importation, but it is part of condition of sale to be added. I have taken the same two examples. I have made one change. In the first case, the exporter is telling, no worry, you pay me 1 crore and you pay me 10 lakhs for the installation. You don't pay me 10 lakhs, you pay the engineer on my behalf. 20 lakhs, you take care of yourself. If you want, I'll send my person. If you don't want, you take care of yourself. In that case, installation charges 20 lakhs will not be added. I change the question a bit. That 20 lakhs installation is a condition of sale. The seller of USA is very much concerned with the brand value. He tells that no. I cannot allow any person to install it. I'll be sending my person, my engineer. He'll be coming there. He'll be installing it. So you have to pay me 1 crore for the machinery, 10 lakhs for the installation condition of sale, add it. 20 lakhs for installation in India as a condition of sale, add it. So please change that. It has to be added. Interest on late payment, unlike your GST, will not be added if it is genuine interest. In GST, interest on late payment is added. In customs, it is not added. It is not added. Any other work which is done in India, normally any work which is done in India after importation is not added, assuming that it is not part of condition of sale. It is not part of condition of sale. If it is part of condition of sale, add it. If it is not part of condition of sale, forget about it. So that is all and all about your 5 additions of rule 10.1. 5 additions of rule 10.1. Now what are the 2 additions of rule 10.2? What are the 2 additions of rule 10.2? To understand the 2 additions of rule 10.2, let us take this directly, summary directly. You see this summary, it tells how you have to work out your question. Your answer should be in the same type. Particulars, amount in foreign currency, exchange rate, amount in Indian rupees. Line by line conversion do. Don't do total conversion. Line by line conversion you do. What is the first thing? You will be adding your FOB price. That is the exporter's price. Exporter of USA's price. Then add 5 additions of 10.1 which you have discussed in totality. Then add 2 additions of 10.2. Sequence should not be changed. It is FOB plus 10.1 then plus 10.2. Why? You'll understand now. Sequence should not be changed. I say at times will present the answer changing the sequence. But final answer will be the same. I say will try to give an answer which is in a very complicated way. Don't change the sequence. Don't change the sequence. First it is FOB at 10.1. You'll get the corrected FOB or you'll get the adjusted FOB. You'll get the corrected FOB or you'll get the adjusted FOB. Then add 10.2. 10.2, what are the 2 additions? 10.2, what are the 2 additions? One is your freight. Technically it is transport, loading, unloading and handling. It's not only freight, it is transport, loading, unloading and handling charges. We are going to call it as freight. And then you have insurance. If you know the freight amount, if the freight amount is given in the question, take the actual freight amount. Take the actual freight amount. If insurance is given in the question, take the actual insurance amount. If it is ascertainable, take the actual value. But wait, for freight there is a catch. Even if freight is known, if it is a case of air transportation, freight that will be added is actual cost or 20% of adjusted FOB, not the original FOB. What is adjusted FOB? FOB plus 10(1). That is the reason you have to follow the sequence. It is actual or 20% of adjusted FOB, whichever is lower. For what? Only for the purpose of air. Otherwise, you'll add actual. So if you know the freight, add it actually. But if it is by way of air, it is actual or 20% of adjusted FOB, whichever is lower. For insurance, if you know the insurance, add the actual value. But what if you are not aware of freight? Let us only take freight first. If you don't know the freight, but you know the adjusted FOB. If you don't know the freight, but you know the adjusted FOB. If you're not aware of the freight, but you know the adjusted FOB, what to do? Take 20% of the adjusted FOB, not FOB. FOB plus 10(1). Now, there may be one more possibility that you don't know the freight amount, you don't know FOB separately, but you know FOB and insurance. You don't know FOB separately. You know FOB plus insurance. You don't know the split up between them. You don't have an option. What to do? Go with 20% of adjusted FOB plus insurance. Now what about insurance? If you know the insurance, go with the actual value of insurance. If you are not sure of the insurance, but you know the FOB, go with 1.125% of adjusted FOB. What is this adjusted FOB? FOB plus 10(1). No freight and all. FOB plus 10(1). Now, if you don't know insurance and you don't know FOB clearly, you know FOB with freight. Go with 1.125% of adjusted FOB with freight. Are you guys clear with this understanding? If you know the freight, add actual, but one catch for air, it is actual or 20% of adjusted FOB, whichever is lower. If you don't know the freight, you know the FOB, 20% of adjusted FOB, not FOB. If you don't know the freight, you know FOB with insurance, 20% of adjusted FOB, not FOB. Adjusted FOB, which means FOB plus 10(1). 20% of adjusted FOB and insurance. Now, when you talk about insurance, if you know the insurance, add actual. If not, if you know the FOB value, go with 1.125% of adjusted FOB. FOB plus 10(1). If you don't know the insurance, but you know FOB and insurance, FOB and freight together. If you don't know insurance value and you don't know separately FOB value, you know FOB with freight together. Then your insurance is 1.125% of adjusted FOB with freight. It is all about this 10(2) additions. Few important points in your 10(2) additions. Please understand that when you talk about your demurrage charges, light rate charges, bar charges, they will be treated as freight. You will be adding in 10(2). When you talk about your demurrage charges, light rate charges, bar charges, which is only there for vessel. Demurrage charges, light rate charges, bar charges. Demurrage charges is for waiting the vessel. Light rate and bar charges is for bringing the vessel to the shore. Transferring the goods from mummy vessel to daughter vessel and bringing it to the shore. It will be treated as freight. freight added along with 10.1. Added along with 10.1. If you talk about demurrage charges for airline, demurrage charges for airline, that will not be added. Demurrage charges for vessel will be added, for airline not added. For vessel added, for airline not added. Bar charges and light rate charges are only for vessel, so there's no question. Bar charges and light rate charges are only for vessel, so there's no question, it will be added. Now, another point that you need to remember is, please understand that anything which is happening in India, anything which is happening in India will not be added. Anything. The goods have reached the first point in India. After touching the first point, any transportation charges will not be added. The goods have reached Chennai port. From Chennai port, they are going to go to Coimbatore, not to be added. The goods have reached Chennai port. From Chennai port, they are going to go to Delhi ICD, which is another port, not to be added. The goods have reached Chennai port. From Chennai port, they are going to public warehouse, not to be added. The import continues, but not to be added. Anything which is happening in India with respect to your freight and insurance, which means your transport, loading, unloading, handling, not to be added. Not to be added. Anything which is happening in India is not to be added. Are you guys clear with this understanding? Are we guys clear with this understanding? Anything happening outside India, freight added. In India, not added. Outside India, added. In India, not added. Please remember that. So if it is freight in USA, freight in India, and freight between USA and India, freight 1, freight 2, freight 3. What about freight 3? To be added, not to be added? Freight 2, to be added, not to be added? To be added in your 10-2 adjustment. 10-2 adjustment. Freight 1, to be added, not to be added? To be added. Technically, it should be added in FOB, but ICA tells that it is to be added along with, and it confuses a lot. ICA does not have a very standard policy. In that scenario, it confuses a lot. How it confuses? It tells, let us take an example. Let us take the numbers here. The price, assume that the price is 1 lakh. Assume that the price is 1 lakh. Freight outside India is, say, 10,000. Freight between site in USA is 10,000. Freight between USA and India is 15,000. And freight in India is 5,000. Let us assume that all these numbers are in Indian rupees for simplicity purposes. Obviously, you have to convert into rupees, but let us understand that it is Indian rupees. Now, understand what should be the right answer. Your right answer should be FOB 1 lakh plus your freight, which is part of FOB 10,000. So your adjusted FOB should be 1 lakh 10,000. 1 lakh 10,000. 1 lakh 10,000. Then your 10-2 freight. Your 10-2 freight should be only freight 2. Should be only freight 2. Assume that this transportation is by way of air. It is by way of air. What should be the answer? What should be the answer? Maximum of 15,000 or 1,10,000 multiplied by 20%, which is 20. Okay, we'll change this 15,000 to 25,000. We'll change this 15,000 to 25,000. So maximum of 25,000 or 1,10,000 multiplied by 20%, which is 22,000. Whichever is lower, not maximum. Whichever is, you have to go with this. Right? This should have been your correct answer. And your final answer would have been 1,32,000. But ICA tells no. ICA tells forget about insurance for the time being. We'll focus only on freight. We are trying to understand what is the difficulty in understanding your insurance will be added, by the way. 1.125% will be added. I am not focusing on insurance at all. Yes, insurance will be added. If the question is not given, even in that case, insurance will be added 1.125% of adjusted FOB. But ICA tells that what is FOB? ICA tells that FOB is only 1 lakh. Therefore, your adjusted FOB is only 1 lakh. Your adjusted FOB is only 1 lakh. What about rule 10(2) freight? Here you are going to add freight 1 as well as freight 2. Freight 1 as well as, what is freight 1 as well as freight 2? Actual 35,000 or 20% of, no. Now I say it as a 20% of 1,10,000. Now I say it as that it is 20% of, if it is going wrong, it could have said 20% of 1 lakh. Now I say it as that no. The real FOB is 1,10,000. 20% of 1,10,000. 20% of 1,10,000. So what is that? 22,000. Let me not write the final answer because obviously there will be insurance. There will be even, I am not going to write the final answer. There will be insurance. And even for insurance, you should know what is adjusted FOB. For inclusion in 10.1, it tells freight 1 and freight 2 will be included in 10.1. But for calculating the percentage, it tells that no, freight 1 was part of FOB. So what is the answer you get? What is the answer you get? It is not 20,000, it is 22,000. It's not 20,000, it is. And wait, insurance will be 1.125% of what? Not 1 lakh. 1,10,000. 1 lakh. So this is ICA's understanding. Go with ICA's understanding. ICA tells that freight 1 as well as freight 2 is included in 10.1. It is included in 10.1. Both freight 1 and freight 2. Logically, it should be freight 1 should be part of FOB and freight 2 should be 10.1. Sorry, freight 1 should be part of FOB and freight 2 should be 10 to adjustment. Freight 2 should be 10 to adjustments. But ICA tells that no, both freight 1 and freight 2 are 10 to adjustments. But when ICA is calculating percentages, be 20% of adjusted FOB or 1.125% of adjusted FOB, then they tell that no. For inner calculation, FOB is not 1 lakh, FOB is not 1 lakh, FOB is 1,10,000. 1,10,000. So that you need to remember. That completes our main discussion of your valuation. And once you are done with valuation, make sure that if the question is also asking about import duty, valuation should be always in this presentation. Particulars, foreign currency, exchange rate, Indian rupees. And FOB, 10.1 additions, adjusted FOB, then 10 additions. And once you get that, you have to calculate different types of import duties. The normal import duties will be BCD, SWS and IGST. But what are the different types of import duties? It can be BCD and protective duty. The first type. Then it will be social welfare surcharge. Then it will be special import duties, including your safeguard measure, anti-subsidizing duty, anti-dumping duty. Finally, it will be IGST and compensation cess. Why I am splitting into 4? For BCD and protected duty, your value will be the value that you have found out. Your value will be the value that you have found out. Supposing you have found out the value as 1 crore. For BCD and protected duty, which is practically BCD for all purposes. Protected duty will work like BCD. It will be on 1 crore. It will be on 1 crore multiplied by the percentage. 1 crore multiplied by the percentage. For social welfare surcharge, your social welfare surcharge will be on what? Will it be on 1 crore? No. It will be on BCD plus protective duty. BCD plus protective duty. And the percentage is 10%. What about your special import duties? They will have their own separate calculation. That calculation will be a totally separate calculation. You have to find out the answer and add here. What about your IGST and compensation cess? What is the value? All. If you go with only all duties, you will forget 1 crore. It starts with value. It starts with value. The important part is it starts with value plus all the duties, be it BCD or protective duty or social welfare surcharge or special import duties, everything multiplied by the percentage. Make sure that whenever you are working out your duty, have all these columns: particulars, value, rate and duty, to avoid silly mistakes. That is how your calculation of import duty needs to be done. Calculation of your import duty needs to be done. So that is the main part of your import valuation. We are done with the main part of import valuation. Rule 3 read along with your Rule 10. Rule 3 read along with your Rule 10. All the other rules are very basic and simple rules. Normally not asked in exams as well. Very basic, because the question itself will give an answer. Just like in GST, you have Rule 27, 28, 29. You will never get any questions directly from 27, 28, 29. Why? The moment you see the question, you have the answer. Now, what is Rule 4 and Rule 5 talking about? We have discussed this in your GST, so the slide will be very simple here. What is Rule 4 and Rule 5 talking about? Rule 4 talks about identical goods and Rule 5 talks about similar goods. What is the difference between identical goods and similar goods? Identical goods are exactly the same in all aspects, including physical characteristics, quality and reputation. They might have minor differences, but that will not affect the value. Similar goods means they are not same in all aspects, but have like characteristics and component materials, which enables to have which makes them perform same functions, and they are commercially interchangeable. They are exactly not the same, but they are not very different also. How? They have the component materials and characteristics such that they are commercially interchangeable. And they perform the same functions. Which means if you go to market and if you compare both these companies, they'll tell that okay, both these companies have got the same brand value. They are not exactly twins, but they are similar. If there is too much variation, it is neither identical nor similar. Now, one more condition that you need to understand when you're seeing identical goods, similar goods. These goods should have been imported from the same country of exportation. If my goods are imported from USA, when comparison is done, the comparison should be done of other goods from USA to India. If you are trying to value my goods which have been imported from USA to India, the comparison should be also from USA to India. The persons can be different. Exporter of USA can be different and importer of India can be different. Country of exportation and country of importation should be the same. Exporters and importers can be different. And your identical goods, similar goods will not include a particular case where you have already given a concession. If you recall, in 10.1 edition, there was 10.1b. If I am sending designs from India, it will not be added. Assume that my goods are imported from USA. All of your goods are also imported from USA. All of you are my reference points. My answer will be based on your answer. But wait, amongst all of you, there is one person who had initially sent designs from India to outside India. That cannot be my reference point. Why? For that person, the value would not be the real value. Why? Design was not added. Design was not added. I'll repeat it. My import is from USA to India. All your imports are also from USA to India. By the way, I can compare all of you, assuming that all the other conditions are satisfied. Now, when I'm comparing, I'm seeing a particular person who had imported from USA to India, but she had given designs from India. When she had given designs from India, that design portion was not added back in terms of 10(1)(b). That cannot be the reference. There was a concession given to her by not adding. I cannot take her as the reference point. I cannot take her as that is the exclusion in your identical goods as well as similar goods. What are the steps that you have to follow? First, go with rule 4. Try to find your answer based on identical goods. If not, go to rule 5. First, go to rule 4. If not, go to first find out your identical goods, similar goods from National Import Database. National Import Database. Then see whether they were imported at or about the same time. You cannot see old imports. You cannot see old imports. Then see whether their assessment was final assessment and whether their assessment was done under rule 3 itself. When I am referring someone else, it should be realistic. It should be at or about the same time. And when I am referring you, your value should be neat and clear. If your assessment was provisional assessment, I cannot refer you. If your valuation was not done under rule 3, it was done under 4, 5, 7, 8, 9, I cannot refer you. So it should be first locating identical goods, similar goods. They should have been imported from the same country to India. Exportation country, importation country should be the same. Then filter out old imports, remove them. Then filter out those cases which are under provisional assessment and which were under rule 4 to rule 9. Remove them. They cannot be the reference point. Then see which all transactions are having same commercial value, same quantity, commercial effect and quantity effect. If not same, then try to give an adjustment. Try to give an adjustment. Also give an adjustment for the freight and insurance. Correct? Why? The comparative could be import from USA one city to Chennai, and it could be, my case could be USA another city to Mumbai. So I have to even give freight and insurance adjustment. Freight and insurance, I have to give two adjustments. One, commercial adjustment, quantity adjustment. Other, freight and insurance adjustment. If after doing all this, I get multiple answers. If after filtering out all of them, still I get multiple answers. I get 4 answers. I had initially 10 answers. I removed all unwanted. I still get 4 answers. What is the solution? Go with the lowest. Go with the lowest. The same step is there for rule 4. The same step is there for rule 5. But first try rule 4. If not successful, then try rule 5. If not successful, then try rule 5. First rule 4, then rule 5. If not successful in rule 4 and 5, what is the next step? Rule 7, which is addition method. Rule 7, by the way, which is deduction method, subtraction method. Rule 8, which is an addition method. Rule 7, subtraction method. Rule 8, addition method. Let us try to understand in a very simple way from this example itself. Supposing the goods were imported from USA to India. My valuation was rejected under rule 3. It is rejected under rule 4. It is rejected under rule 5. Now, please understand that other similar goods would have been imported and sold in India. Would have been imported and sold in India, not my goods, other goods. Other goods would have been, other identical goods or similar goods would have been imported and sold in India. Sold in India, take that selling price. Take that selling price and reduce from that selling price whatever happened in India, reach at this point. Reduce from that selling price whatever happened in India and reach at the cost. Now please tell me what all will have happened in India. There would be taxes and duties in India. Remove it. There would be transportation and insurance in India. Remove it. There would be selling expenses and profit margin of those people in India. Direct selling expenses and profit margin of those people in India. Remove it. At times, there will be some value addition in India. This person would have changed the packaging. Value addition should not amount to manufacture. There would have been some value addition in India. Remove it. Remove it. Whatever happened in India, be it taxes and duties in India, be it transportation, insurance and associated costs in India, be it your selling expenses and profit margin in India, or be it value addition in India, but that value addition in India should not amount to manufacture. Should not amount to manufacture. Remove all of them. Remove all of them. Get the answer. Remove all of them. Get the answer. But there is one problem. When I am referring to identical goods, similar goods, there will be multiple identical goods, similar goods, which are sold at or about the same time. When I am importing my goods, at that time, identical goods, similar goods will be multiple. My same item would have been sold in India by multiple people. Please understand that those identical goods, similar goods should also have been imported from the same country into India, then sold. Then sold as such at or about the same time. At or about the same time. What if I get multiple? What if I get multiple answers? Which selling price should I take? If I get 3 reference point, which reference point should I select? Reference point which is corresponding to greatest aggregate quantity. It is neither the highest nor the lowest. It is reference point corresponding to greatest aggregate quantity. Say for example, those 3 reference points, the price was 100, 110, 120. 100, 10,000 units were sold. 110, 12,000 units were sold. 120, 9,000 units were sold. What is the price that I'll take? What is the price corresponding to the greatest aggregate quantity? What is the price corresponding to greatest aggregate quantity? 110. I'll go with 110. I'll go with 110. Which reference point I'll select? I'll select the reference point which is having maximum quantity sale. Which is having maximum quantity sale. I'll select that reference point which is having maximum quantity sale. From there, I'll do all the deductions. I'll select that reference point. In this example, all these calculations will be based on which reference point? All these calculations will be based on reference point 2. Will be based on reference point 2. Are you guys clear this understanding? So how I am going to select my reference point? If I have multiple reference point, select the one which is having the highest quantity of sale. By the way, this 12,000 will be not used anymore. Just to select that transaction, I have referred 12,000. Thereafter, this 12,000 has got no relevance in the entire calculation. Are we guys clear with this understanding? Are we guys clear with this understanding? This is everything about your Rule 7 subtraction method. This is everything about your Rule 7 subtraction method. By the way, one small point is left out in Rule 7. Can I take my own goods as a base? Can I take my own goods as a base, or I should refer identical goods, similar goods? Normally, I should refer identical goods, similar goods. Why? I am trying to find value of my goods. When I am trying to find value of my goods, they are not yet cleared. When they are not yet cleared, there will be no selling price. So I have to refer to identical goods, similar goods. I have to refer to identical goods, similar goods. But there is one way where I can refer my own goods, where I can refer my How? Go for provisional assessment. Go for, on some rough basis, pay some duty. Promise that within 90 days you will sell your goods and you will take your selling price. Starting from your selling price, reduce everything what happened in India. Normally, the basis of rule 7 is other person's goods, identical goods, similar goods. Because when I am importing my goods, they are yet to be cleared. So when they are yet to be cleared, I cannot have selling price. I have to refer to some other goods. But can I refer the own goods and try to calculate entire rule 7? Yes. How? Take the help of provisional assessment. Randomly, roughly pay some duty what officer is demanding now. Promise that you will sell within 90 days. Sell it. Take your selling price. Remove everything that happened in India. Remove everything that happened in India. So that is all about your rule 7. Rule 7. Now, rule 8 is exactly opposite of this, which is addition value. What if I tell you that you are not successful in finding out your rule 7? You can go with rule 8. What is rule 8? You start with the cost of material of the exporter, add cost of production of the exporter, add selling expenses and profit margin of the exporter, add freight and insurance in terms of rule 10(2), you will reach at India, which is CIF. This is nothing but your rule 8. You will start with the exporter. You contact your exporter. Ask his cost of material. Ask his cost of production of fabrication. Ask his selling expenses, profit margin. Add freight and insurance between USA and India. Arrive at your CA value in terms of rule 8. But there is a big problem here. This is workable only in case of related party transaction. Normally, an exporter will never give all this information. Only if he is a related person, he will share all this information. Only if he is a related person, he is going to share all these information. Otherwise, these information will not be shared. These information will not be shared. Right. So that is rule 7, subtraction method, deductive value method. Rule 8, addition method called as computed value. Normally, what is the sequence that we discussed of the rules? Rule 3, rule 4, 5, 7, 8, 9. What is rule 6? Rule 6 is sequence changer. Importer can request and proper officer can accept to change the sequence from 3, 4, 5, 7, 8, 9 to 3, 4, 5, 8, 7, 9. Why this importer will request? Because importer will tell that my transaction is a related party transaction. You have removed from rule 3, rule 4, rule 5. First try rule 8. If not satisfied, then try rule 7. Then try rule 7. That is all about your rule 7 and rule 8. And the last part is your residuary method. Residual method tells that best judgment valuation to the best of the judgment of officer. He will try to give a value. But there is a catch. Officer cannot give a value which is more than the market value of the goods when sold in India. Officer cannot give a value which is more than market value of the goods when they are imported, and it cannot be too high value. It cannot be a very high value. Now, there are certain ifs and buts for the officer. Officer should, even when he is doing best judgment, he should take care of certain things. What are those things? Just think of this, you'll automatically find all these answers. I was importing from USA to India. Can officer take the base as USA China? Can officer take the base reference point as USA China? No. Can officer take the reference point as USA USA? No. Can officer take the reference point as India India? No. So they are trying to tell that when you're trying to find a base, officer cannot take the base as goods produced in India, sold in India, goods produced in the USA and sold in the same country. Goods produced in USA but sold to China. But sold to, the reference point should always be USA, India. If my goods are imported from USA, India, the reference point even in rule 9 should be USA, India. Now what if officer is getting multiple answers? Officer cannot select highest, cannot select lowest, cannot select any arbitrary value or fictitious value. Then what is expected of the officer? If officer is getting multiple answers, select the one which is more appropriate or more logical than the other. He cannot select just because some value is higher, he'll select that. Some value is lower, he'll select that. Some random value, he'll select that. Supposing 100, 112, 115, 120 is the answer. Final answer in terms of rule 9. Officer cannot go with 100, cannot go with 120, cannot go with 112, cannot go with 115, just like that. He has to select any of them, say for example 112, and tell why 112 is more valid than other three. Can you apply your addition method with respect to identical goods or similar goods? When you talk about your addition method, it was applied on your own goods. Can you apply computed value for identical goods, similar goods? Yes. If the formula of rule 8 is applied, no worry. If you don't apply the formula of rule 8, then you cannot do. Now please understand that rule 8 computed value was done on the basis of your own goods. You did not take any reference point. You added everything of your own goods. You did not went to identical goods, similar goods. Under rule 9, can you apply computed value of identical goods, similar goods? Yes. If you apply the same formula that of rule 8. If you apply the same formula that of rule 8. Now just for your understanding purposes, if your value is under rule 3, you'll have only one answer. If you have values under 4 and 5, you may have multiple answers. If you have multiple answers, select the lowest. If you are valuing under rule 7, you may have multiple answers. Which one to select? Select the one which is against the highest aggregate quantity. Highest aggregate, that will be a reference point, and work on the basis of that. In rule 8, you will never get multiple answers because rule 8 is on your own goods. If in rule 9, you are getting multiple answers, most appropriate amongst others you have to select. Most appropriate among others you have to select. For second hand machinery, can you apply depreciated value method? A repeated question. For second hand machinery, can you apply depreciated value method under rule 9? Can you apply depreciated value method under rule 9? Yes, but there is a catch. Even for second hand machinery, start from rule 3, then rule 4, then rule 5, then rule 7, then rule 8, then rule 9. Directly you cannot bring under rule 9. Follow the sequence 3, 4, 5, 7, 8, 9. If you have tried everything else, you have come at 9. Then for second hand machinery importation, you can apply depreciated value method. If you have tried all the rules and then come at rule 9, you can use your depreciated value method. So that is everything about your import valuation rules. What are the valuation rules basically? Main rule is 3, followed by 4, 5, 7, 8, 9. Push, and addition is rule 10. So main rule is rule 3. It will be always straight along with 10 addition. Rule 3 plus rule 10, 1, 5 additions, 10 to 2 additions. Rule 4, rule 5, normally no questions will be touched because the moment you know the logic, straight away you know the answer. But 7 and 8, for sure, 7 importantly, there can be beautiful questions asked in 7, and ICA has asked a few times when you're talking about calculation part of 7. Calculation part of 7, that is subtraction method or deductive value method. So that is all and all about your import valuation rules. When you talk about your export valuation, the moment you find your import valuation, automatically export valuation is 90% done. The main difference between your import valuation and export valuation is import valuation is based on CIF, cost, insurance, freight. Export is based on FOB, because it is talking about the goods when they are leaving India. That is FOB. Import when they are touching India, which is CIF. Now, other differences. In your import valuation, you have something called as identical goods, similar goods, and related person. Same related person is there also. But in your export valuation, you don't have identical goods, similar goods. You have a combo. You have goods of like, kind, and quality. Now, you can easily link with your GST. And by the way, when you refer to the definition of goods of like and kind and quality, they use the term identical or similar. In the BAR Act itself, they use the term identical or similar. They are trying to make it more simple. Just really no need of identical, no need of identical, no need of similar. We'll go with a simple term, goods of like, kind, and quality. What is the main rule for your import valuation rule? What is the main rule? It is rule 3, which is declared value, which has got additional conditions like unrestricted sales, unconditional sales, subsequent sale proceeds should be determinable. In export, just think of this. Export, government wants to add to valuation or to have lesser valuation. Lesser valuation. Because more is the value of export, more will be the export benefits. More the value of exports, more will be the exports. Duty is very rare. Export is all about benefits. The problem with import is undervaluation by assessee and officer will try to add it. The problem with export is overvaluation by assessee, which you have seen in duty drawback, and officer will try to reduce it. Will there be any extra conditions here? Nothing. No extra conditions. No extra conditions. Mind you, along with this rule 3, what was the most important rule? You are going to add 10-1, 5 additions, and 10-2, 2 additions. In export, there are no additions. They don't want additions. They are not interested in any additions. There are no additions. There is no concept of addition. There is no concept of, it is straight away FOB value. It is straight away FOB value. Now, if you are not successful at rule 3, what is the next rule that you take in import? What is the next rule that you take in import? Rule 4 followed by rule 5, which is identical goods, similar goods. In your export, it is goods of like, kind, and quality. It's goods of like, kind, and quality. In import, they are very specific. Country of origin and destination both should be the same. Country of origin, that is exportation USA, and destination, which is India, both should be the same. Both should be the same. More importantly, country of origin should be the same. Because in import, destination is India. Your country of origin should be the same. If you have imported from USA, your reference point should also be from USA to India. But in export, they are not bothered about the destination point. If you are referring to someone else, it should have been exported. You have exported from India to, say, Sri Lanka. When you are taking your reference point, that is goods of like, kind, and quality, that goods of like and kind and quality can be India to Sri Lanka, or India to China, or India to USA. You are not bothered. You are not bothered. So your country of destination may be the same, may be different. May be the same. But yes, you should take only export transaction. Reference point is export transaction, but not necessarily India to Sri Lanka. It may be India to Sri Lanka or India to any other country. Now, what is the next step in your import? Once you are done with 3, 4, 5, what is the next step? What is the next step? You are talking about rule 7. What is that? What is that? Deduction value. Just think of this. For export, can you ever have deductive value? You are exporting from India. Now you are telling go outside India to Sri Lanka. From there, take that selling price, come back. What you will tell? Why you are going there? I am here. I am the exporter. I am here. There cannot be any concept of deductive value. Think logically. It cannot be there. When you are the exporter sitting here, when you can give all your cost of production details, why to go to the other country, take the selling price and return back? Not logical. There's no concept of There's no concept of deductive value. What is the next rule that you'll apply in your import? Rule 8, computed value. Here, yes, you'll have a comparison. If you are not successful with rule 3, declared value. Rule 4, goods of like kind and quality. Then you'll go to rule 5, computed value. See, there it is 3, 4, 5, 7, 8. And export it is 3, 4, 5. Declared value, like kind and quality. If there is no concept of deductive value, there's no question of any changing the sequence. Directly computed value. Declared value, goods of like kind and quality, and computed value. Now, in your import valuation, rule 9 is best judgment valuation. Obviously, you will have best judgment valuation even in your export valuation. So there it is rule 3, 4, 5, 7, 8, 9. Here it is 3, 4, 5 and last best judgment valuation 6. That's it. And in your import valuation, importer has to give a valuation declaration under rule 11 and officer can reject your value under rule 3 based on rule 12. Likewise, there exporter has to give valuation declaration under rule 7 and officer can reject your value under rule 3 based on rule 8 rejection. Very, very simple to understand. The moment you are clear with export, questions are never asked. Rarest of the rare scenarios. But please remember, if at all they ask export questions, there's nothing to worry about. The moment you have gone through all the ifs and buts of import valuation, hardly it will take 5 to 6 minutes to know what is your export valuation. One point don't forget, export is all based on FOB, import is all based on CF. So that is all about your export valuation. Now, when you talk about your valuation question, a part of valuation question is to find out the correct exchange rate. And to calculate the duty, correct rate of duty. Now, please understand the possibilities, and the moment you understand the possibilities, things are very simple. If you're directly clearing the goods from customs station, let us focus only on import. You have filed your bill of entry for home consumption on a particular date, say 1st April, and the goods have arrived. Arrival of vessel, aircraft or vehicle, it is on say 4th April. Another scenario, bill of entry for home consumption is filed on 4th April and arrival of your vessel, aircraft or vehicle is 1st April. First is a situation of advance bill of entry. Second is a situation of normal bill of entry. They'll try to give the numbers in ulta ways. You have to see, in the first case, you have filed bill of entry before the goods have arrived, before the arrival of vessel, aircraft or vehicle. Correct? Before it has arrived. So it is advance bill of entry. In the second case, you have filed bill of entry after the arrival of vessel, aircraft or vehicle. Which is a normal bill of entry. In case of, now let us give the questions. Supposing exchange rate here is rupees 75 per dollar. Here it is rupees 76 per dollar. We'll take the same thing. So it's rupees 75 per dollar and rupees 76 per dollar. Rate of duty is 10%, 20%. Rate of duty is 10%, 20%. This exchange rate in customs, you are going to take CBIC exchange rate. Rate of duty will be given in the question. Exchange rate is always of CBIC. If you get in question RBI exchange rate, FEDI exchange rate, ignore it. Focus on CBIC. Now first select the date, then select the rate. Now tell me what about your exchange rate and what about your rate of duty? For your exchange rate, always go with bill of entry. Always go with bill of entry. Always go with bill of entry. So what is the bill of entry? Date here it is 75 rupees. Here it is again 75 rupees because you are going with bill of entry. Bill of entry. Always go with bill of entry. Here bill of entry was filed on 1st April. Here bill of entry was filed on 4th April. Always go with bill of entry. Always go with bill of entry. For exchange rate, there is no other answer. Go with bill of entry. By the way, exchange rate is part of valuation. This part of rate of duty is calculating duty, but exchange rate is part of valuation. That is discussed in section 14. Exchange rate is discussed in section 14. Rate of duty is discussed in section 15 for import, section 16 for export. What about rate of duty? What about rate of duty? Which one to select? Whichever is later. Whichever is for your rate of duty. Go with whichever is later. Go with whichever is later. Which is later? 1st April or 4th April? 1st April or 4th April? 20%. Now which is later in the second case? 4th April or 1st April? 4th April. So which rate? Got that? Exchange rate always go with bill of entry. But rate of duty go with bill of entry or arrival of vessel, aircraft, vehicle, whichever is later. Whichever is later. This is discussed when the goods are directly cleared from your customs station. What if you are taking the goods to customs warehouse, then clearing it? You will file two bill of entries. Bill of entry for warehousing and bill of entry for home consumption. Bill of entry for warehousing you have filed on say 1st April. Bill of entry for home consumption you have filed on say 10th December. Now your exchange rate given by CBIC will be different on both these dates. Rate of duty may be different on both these dates. Let us assume that your exchange rate is rupees 80 per dollar and rupees 83 per dollar on these two dates. And rate of duty 10%, 20%. For your exchange rate, you always go with the first bill of entry. You always go with bill of entry, that too first bill of entry. You always go with bill of entry, that too. If there are two bill of entries, go with first bill of entry. So what will be the answer? 80. For your rate of duty, you always go with whichever is later. Correct? In that previous case, whichever is later. Now here, there was only one bill of entry with arrival, whichever is later. Here there are two bill of entries. Which is later? Which is later? Second one. So you will take 20%. You will take 20%. Clear? That is for your import purposes. And for export, there will be only two dates: shipping bill, bill of export, and late export order given by the officer. Shipping bill, bill of export filed by the exporter, late exporter order given by the proper officer. Assume that shipping bill you have filed on 10th April, late export order will always be given after that. 15th April. Exchange rate given by CBIC. Rate of duty. Normally export duty will not be there, but if there, what do you have to do? Now let us assume that your exchange rate is rupees 83 per dollar and rupees 84 per dollar on these two dates. Rate of duty within 5 days changed from 5% to 7.5%. Now, if you recollect your exchange rate concept in import, it always goes with the first thing or the last thing. Exchange rate. E, then R. E is first, then it is R. It always goes with first thing. So, it will always go with the date of shipping bill or bill of export. So, your exchange rate will be 83 per dollar. What about your rate of duty? If you understand your import, your rate of duty always goes with the earlier thing or the later thing. What is later? late export order. So what will be the rate of duty? 7.5%. 7.5%. Exchange rate, be it import or export, is discussed in section 14. Rate of duty for import is discussed in section 15. And rate of duty for export is discussed in section 16. Are we guys clear with this understanding? Are we guys clear with this understanding? It is just like your time of supply to select the correct rate and to find out the final payment. It is just like your time of supply. Don't you think in your time of supply there will be a residuary provision? Assume in import and export, you don't file bill of entry, you don't file shipping bill of export. You are a smuggler. You are a smuggler. What will happen? What will be the relevant date? Remember your GST. What will be your? In case of smuggling. In case of smuggling. Date of payment. Date of payment. That will be the relevant date. Something is better than nothing. At least have that relevant date. Something is better than nothing. It is date of payment. So that is everything about your selecting the exchange rate and selecting the rate of duty, which will be part of your valuation question. Thank you.